Shri Ashok Bhattacharya, Professor Chetan Ghate, Dr. Rajeswari Sengupta, Shri Shishir Gupta, ladies and gentlemen, I extend a very warm welcome to all of you. As you are aware, we conduct a very important program, mid-year review of Indian economy every year around this time. Actually, this program was started by Dr. Malcolm Adiseshiah when he was alive, and he was very, very active member of IIC. After his death, an endowment has been set up in the name of Dr. Adiseshiah and his wife Elizabeth. It is called Malcolm Adiseshiah Elizabeth Endowment. So this endowment every year supports this program. In this program, we review the Indian economy, and also we discuss the challenges which are ahead for the Indian economy as such. Before I hand over the floor to Sri Ashok Bhattacharya to conduct the program, let me first say a few words about Dr. Malcolm Adiseshiah and also introduce the chair. Malcolm Satyanathan Adiseshiah, he was born in Madras. He was an Indian development economist and educator. In 1976, he was awarded the Padma Bhushan, India's third highest civilian honor. In 1998, UNESCO created the Malcolm Adiseshiah Memorial Literary Prize in recognition of his contribution to education and literacy. He was nominated to Rajya Sabha in the upper house of Indian Parliament in 1978. So we really remember him very, very fondly. The whole IIC family really, respects him. Today's, program is going to be chaired by Sri Ashok Bhattacharya. I would like to just present a brief, introduction of his. He is a senior economic.
Very brief.
Very brief. Very brief. Sri Bhattacharya is a very senior economic journalist with over 4 decades of experience. His business standards editorial director. He had set the bar for business reporting as the chief bureau of Economic Times in early 1990s. When economy reforms raised, he had a ringside view to many other disruptions, creative and otherwise. Editorial director, business standard and distinguished visiting fellow, Ananta Center, Sri Ashok Bhattacharya, after a 10-year-long stint with the Financial Express between 78 to 88 in different capacities in the areas of news gathering and news management, joined the Economic Times in 1988 and functioned as its bureau chief from 90 to 1993. In 94, he became associate editor, and thereafter he had his stint in Pioneer as executive editor. Business Standard he joined in 1996. He has been writing a regular column, the New Delhi Diary, commenting on government affairs since 1990. That appeared in Economic Times, Pioneer, and now it appears in Business Standard. So today's lead speaker is going to be Professor Chetan Ghate, and we have two very eminent, discussants, so Dr. Rajeswari Sengupta and Shri Sengupta. All these three dignitaries are going to be introduced by the chair. So with these few words, I hand over the floor to Sri Ashok Bhattacharya to conduct the proceedings. Over to you, Mr. Bhattacharya.
Yeah. Thank you, Mr. Srivastava. Very good morning to everybody here. Before I introduce the eminent speaker here who will present his paper, Dr. Ghate, and the discussants, Dr. Sengupta and Mr. Gupta. I just wanted to say that this annual event is something of a kind of uh, uh, a development that always sort of marks the beginning of probably uh, the budget making exercise in the government, in the sense that this probably is the first input that the government may be receiving from outside on how is the economy doing. And in the, since I was presented as a very old man in the 1980s or 1990s, I I remember I remember this meeting used to be a place where even some people from the finance ministry would be coming and listening to just to go back into North Block and understand that where do we stand from the government's point of view. Um, and so therefore, what we are going to do today here will have a bearing not just on the state of the Indian economy right now and the way it is panning out, but also probably will provide as inputs to government policy making in the months to come. Now, let me introduce our lead presenter today, Dr. Chetan Ghate. He is the director of the Institute of Economic Growth in New Delhi, and he's also a professor of economics in the Economics and Planning Unit, Indian Statistical Institute, and he has been doing it since 2003. He received his PhD in economics from Claremont Graduate University, California. We have some fascination for California. The other discussant is also from California, education-wise. He completed his MA in economics from the Delhi School of Economics in 1995, and his research focus is in the fields of macroeconomics, monetary economics, economic growth, and development, and the Indian macroeconomy. In 2014, he was awarded the Mahalanobis Memorial Gold Medal given to the best research economist in India under the age of 45. Dr. Ghate has held several visiting faculty positions in India and abroad and has been closely involved with the Reserve Bank of India in an advisory capacity. And most importantly, he was a member of the Reserve Bank of India's first Monetary Policy Committee until October 2020, which is 2017, 2016 to 2020. And from 2012 2013, he was the RBI Chair Professor in Macroeconomics at IGIDR. From February 2013 to September 2016, he was a member of the Technical Advisory Committee for Monetary Policy at the Reserve Bank of India. And in September 2013, he served as a member of the Expert Committee to revise and strengthen the monetary policy framework. Dr. Ghate chairs Academic Advisory Board of the Reserve Bank of India Academy and serves on the editorial board of the RBI Occasional Paper Series. He is also an external affiliate of the Center for Research in Macroeconomics and Macrofinance at Swansea University. He is a member of the CII Economic Affairs Council. He is also a member of the Macrofinance Society and a research associate at the Center for Applied Macroeconomic Analysis at the Australian National University, Australia. Thank you, Dr. Ghate, for accepting our invitation to be here. Let me go over to Dr. Rajeswari Sengupta's brief profile. Dr. Sengupta's research focuses on policy-relevant issues of emerging economies in general and in India in particular, in the fields of empirical macroeconomics, international finance, monetary policy, banking and financial institutions, firm financing, and national accounts measurement. In the past, she has held research positions at the Institute for Financial Management and Research in Chennai, San Francisco Federal Reserve, the World Bank, the International Monetary Fund in Washington, D.C., and the Reserve Bank of India, Delhi. She was a member of the Research Secretariat to the Bankruptcy Law Reforms Committee and that drafted India's Insolvency and Bankruptcy Code. She has published in reputed international journals such as Journal of Money, Credit, and Banking, Economic Policy Journal of International Money and Finance, the World Economy, Emerging Markets Review, Pacific Economic Review, Open Economies Review, as well as the Economic and Political Weekly in India. She has also written chapters in various books published by Asian Development Bank, G20, the Center for International Governance Innovation, among others. Dr. Sengupta completed her MA and PhD in economics from the University of California, Santa Cruz. She holds 2 previous degrees in economics from India, a bachelor's degree from Presidency College, Calcutta, and a master's from Delhi School of Economics. Let me now turn to Dr. Shishir Gupta. He is a senior fellow at CSEP in New Delhi. His work focuses on many aspects of the Indian economy, including economic growth, governance, and institutions, urbanization, and subnational reforms, among others. Before joining CSEP in August 2020, Mr. Gupta was a fellow with the McKinsey Global Institute for 14 years, where he led multi-ethnic teams in India and the US on policy research and client studies across multiple domains. He has written extensively on these topics in MGI reports and research papers, as well as in popular media. He is an economist by education with an MA and MPhil from the Delhi School of Economics. Let me welcome Dr. Sengupta and Mr. Gupta also. Thank you for agreeing to be a part of it. Without much ado, what I would do is, I would now request Dr. Ghate to make his lead presentation. And the structure of today's meeting could be that you make this presentation for about 45 minutes, and after which we invite Dr. Sengupta and Mr. Gupta to make their comments on the paper, and then we throw it open for a discussion, and then we continue the discussion over meal. Dr. Ghate.
Great, thank you. Well, good morning, everybody, and at the outset, let me thank Mr. Srivastava, Director IIC, Mr. Bhattacharya, who initially contacted me to do this. I also want to thank Ghate, who coordinated a lot with me on this, and I'm grateful to the Malcolm Adiseshiah Trust also for facilitating this, and also say my warm greetings to both Shishir and to Rajeswari. Okay, so this is the mid-year review of the Indian economy. It's about 89 slides. I have to get through 89 slides in about 45 minutes. So I have a bit of an ambitious task. So I may be a little fast. There is a paper that I've written for this review. I think at some point it will be made available to participants in the form of some publication, or maybe it'll be disseminated at some point. But I'm very grateful for your feedback on it, and this is very much work in progress. I've been working on this for the last 2 months, very heavily actually. So let me just jump into it. Next slide, please. So this is what I'm going to do. I want to give a long-run picture on what's driving Indian economic growth first. I've attended a lot of these mid-year reviews, and the focus on it tends to be very short-term and in terms of cyclical dynamics, so to speak. So I'll talk about the long-run drivers of growth. Then I'll talk about the demand side of the economy, that's domestic absorption. So that's basically C+I, consumption and investment. Then trade, exports and imports, government expenditure. I'll draw on some research that I'm doing on public debt. And then I'll move to the supply side. I'll talk about trends in 3 sectors: the agriculture, industry, and services. I'll talk about the unemployment data a little bit. And there's some puzzling features in it. And then next slide, please. And then credit, inflation, external resilience, and balance of payments. I won't have time to talk about structural reforms that much. If we have time, we can bring this up in the discussion, and then I'll conclude. So there's a lot on the table, so let me just jump right into it. So here is a graph of GVA growth, okay, using CLEMS from 1980 to 2019-20, last 40 years. Now, the grayish line is the capital input, the physical capital input. The blue line, the bar graph, is the labor input. And the reddish bar graph that you can see going below zero is the productivity input. Okay, so this is what is called the growth decomposition, and this is done for many countries over many time periods, and we've done this for India, and this is part of an RBI DRG study that I just finished a couple of months ago. Now, the incredible feature of this graph says that what has been driving growth for the last 40 years in India is the capital input. On average, that contribution is close to 65%. In other words, of the observed GVA growth in every year, 65% of that is the capital input. Then you have the labor input, which is about 31%, and then you have total factor productivity, which is what is left, and that's the reddish bar. So what you see here is that TFP growth in many years is negative, and that's what pulls the green line down relative to the bars. Now, there are a few implications of this. First is that if you had high growth driven by productivity, that would make the economy less prone to inflation. That's the first kind of broad observation I want to make. Second thing is, high productivity also makes the economy more capable of sustaining budget deficits. And the third broad observation I want to make is a high productivity is also more likely to deliver strong wage growth. Okay? So what we do see here is that total factor productivity is not a big part of what is driving GVA growth over the last 40 years. And this is estimated from CLEMS. This data is publicly available. And this does a growth decomposition using GVA numbers. Next slide, please. Now, if you do the same exercise using CLEMS data for 40 years and decompose total employment between self-casual and regular. So there are different definitions of what regular is, whether you use PLFS or you use CMIE. Current weekly status, there's usual status, which is divided between principal and subsidiary. I'll get into all of that. But the other remarkable feature of the Indian economy is that if you break up total employment between these three different parts, casual workers were about 23% of the workforce in 1920, and they were 29% of the workforce in 1881. So the extent of casual workers in the economy has only gone down by about 6% in 40 years. Formal employment, which is regular wage work, is in 1881 was about 13%, and in 1920 is about 24%. And later on, I'll put up a chart indicating that of this regular workforce share, what percent has three benefits that we typically associate with Social Security, and what proportion doesn't. But the regular workforce share is fairly small. It's about 24%. And then, of course, if you look at the bulk of employment in India, it is self-employment. Okay? And in the PLFS, self-employment is defined very clearly. You can either be an own account worker or you can be an employer and so on. And then there's female, male, urban, rural, and I'll talk a little bit about that. So what I'm putting forward is this, is that in the aspiration to get between 6 to 8% growth, we're trying to get it on the back of a workforce, an employment level, which is predominantly self-employed. Okay, and that is a challenge. Okay, next slide, please. This, again, takes a long-run view, not as long as 1980, but from 2012 onwards. So we see real GDP growth kind of constant at about 7% till about COVID, March 2020. We see this is based on quarterly data. So you see the sharp contraction in Q1 of FY21 for COVID, and then you see this rebound effect, and then, of course, growth has been very high in the last 3 years, 21, 22, 22, 23, and 23, 24. And now we see the slight dipping, and these are based on the Q1 FY25 growth numbers. And so the bulk of this presentation is going to be about that dip, trying to understand why the economy is kind of, if you see that very end, it looks like it's tapering off. Next slide, please. Okay, so let's break up this analysis between the demand side. So this is largely domestic absorption. Domestic absorption just means consumption and investment. and government spending, to be accurate, but I'll treat government spending separately. So here are some claims. First, I see growth is moderating. The FY25 growth is likely to be in the 6.5 to 7% range. I think there were many forecasts at the beginning of the year suggesting that it was about 7%, but it's likely to be in the 6.5 to 7% range. Now, why this may be the case is that it partly reflects a decline in momentum in many high-frequency indicators. I'll show this in a second. One slightly new perspective is that we show that the output gap is closed. The output gap is just actual output minus potential output. Economists define potential output as that level of output consistent with not zero unemployment. This is a slightly technical phrase, but this is a public lecture. What economists think about as unemployment as being in its natural state. So if you have unemployment being in its natural state, this is the level of output associated with that. That's potential output, and it's typically picked up by trend. So the output gap is closed in March 2023, and that may be partly one reason why we will expect the economy to grow. Okay? I've estimated a demand index using ongoing work, which appears to be turning downwards. There's some correction in credit growth. It was running faster than nominal GDP growth, and now it seems to have slowed down a bit. And then one thing that may come up in the discussion is that government spending has also been subdued in the first 5 months, and I'm still not 100% clear on why this is the case. Is it elections? Has the economy hit a capacity constraint? This is a government that is very focused on the fiscal deficit, which is a good thing. But if you would say that it's government spending is constrained because tax collections are low, that's not the case, because tax collections are not low. So it is some combination of these, but I'm not 100% clear. And then if you look at exports, it's contracted in Q2 by minus 3.8%. So next slide, please. So this is not completely clear, but what you see here is several high-frequency indicators. What may be visually more clear is that if you look at the last 3 columns, which take you from August, September, and October, and we don't have all high-frequency data for October. In fact, the October numbers are a bit of a puzzle because it seems to suggest that growth may actually pick up again so from October onwards. But that's still a very tentative thing. But we're looking at Q2. If you look at Q2, you see more red bars in those 2 columns across August and September. And the red bars indicate either a negative growth rate corresponding to the indicator on the left or a very small positive growth rate. You see more red bars in a way that you don't see coming up into June or July. So, and this is across a variety of indicators. For instance, if you look at rural demand, diesel sales in August were negative. If you look at construction, this is in August. Cement output was negative. If you look at industrial activity, electricity demand was negative. If you look at railway freight traffic, it registered no growth. If you look at port cargo traffic in October, it's negative. If you look at commercial vehicle registrations, it's negative for the last 3 months and so on. So this is one sense that in terms of the high frequency indicators, because we don't have Q2 numbers yet, right? Q2 numbers are going to come out on November 29, so we don't have them yet. So to fill in the gap, we're looking at these high frequency indicators, and this seems to suggest that across a variety of cyclical indicators, there are more red bars, and that seems to suggest that that there's possibly a slowdown. Next slide, please. Now, this is what real GDP, again, I'm looking at real GDP at market prices. So here, and I'll get into this in a second, for Q1 FY25, private final consumption expenditure registered a growth rate of 7.4. Government final consumption expenditures registered a growth rate of minus 0.2%. Imports of goods and services is relatively lackluster. Typically, if imports are down, that seems to suggest that, aggregate income is down, the economy is importing less. That may be one indicator of it. Exports in Q1 was 8.7, but in Q2, for which we have data, it registers a contraction. Valuables, changes in stocks are a very small fraction of gross capital formation. The bulk of it is gross fixed capital formation. So, I think changes in stocks and valuables are about each of them are about 1% of GDP. The bulk of it is fixed capital investment. The momentum of that is slowing down, as I will show. And of course, gross capital formation, I have some observations on this based on the data. But kind of the puzzle I'm trying to hear on the government side is that because the spending has not been as much as relative to BE, that could be part of the reason why we may be seeing a little bit of a slowdown. Okay, let's just keep these numbers in mind. In Q1 FY25, GDP at market prices was 6.7%. We had remarkable growth between FY22, FY23, and FY24 of 9.77 and 8.2%. That would be some of the fastest growth rates in the world. And then, of course, this is now 6.7% in Q1 FY25. Next slide, please. What I find based on recent work here, and I think what is relevant for this audience is this purple line. The purple line is a demand index constructed for the economy. And what we see for the demand index constructed for the economy, so the left-hand side goes from 2012 Q3 to 2021 Q1. And then the right hand picks up from 2019 Q1, and we update it to 2024, more or less still, because these are based on monthly indicators. So we have data for this up to October. But what you see on the right-hand side is that the purple line, if you look at the very fag end, it seems to be picking up. That would be, April, May, June, July, August, September, October. But if you see the little part where it's falling before it picks up, our demand index seems to be falling, okay, across these 10 high-frequency indicators. That seems to suggest that in Q2, the demand index has fallen, and that is, going to show up ultimately going to show up in our growth rates. Next slide, please. Now, let's go through the big shares. So, as you all know, private consumption, PFCE, and these are NAS numbers, India's like a lot of emerging markets. It's PFC is about 55 to 60% of GDP, like a lot of emerging market economies, and that is the you can see that line there on the I think it's the blue line. That's it's been falling. Okay, so it's and the scale suggests that it's ranging between kind of 59 and 57. But the red line is giving you the 3-quarter moving average. So you just take the averages across the last 3 quarters. Of course, the latest numbers that we have for this is Q1 FY25. That is falling. So that's suggesting that PFCE momentum using a 3-quarter moving average is falling. Now, we have some proprietary high-frequency indicator data on ATM and point-of-sale transactions. And that also seems to suggest that there's a contraction in consumption. And I've written this up in the paper. It's contracted by about 1.5% in Q1 FY25 against a positive 3.5% growth in Q1 FY24. So even in terms of ATM and POS and online transactions, we seem to be getting this decline. Next slide, please. Here is the next part. This is investment. So on the left-hand side, I have real and nominal investment. And the remarkable feature about our investment rates, whether you see them in terms of nominal or real shares, so nominal investment relative to nominal GDP and real investment relative to GDP, it is somewhat flatlined after 2010. Now, if you look at the right-hand side, so if you just take a vertical line on the left-hand graph, and that, somewhere in the middle where you see it flattening out, our shares have become constant. Now, if you look at the right-hand side, and the right-hand side, the blue line is basically real investment growth. This is the growth rate of real investment. This has been roughly across the sample period between 96, from which the point in time we have quarterly data available all the way till Q1 FY25, it's about 6.7%. The point I want to make here is that if you say that investment has flatlined and investment therefore is stalled, You could argue that if you look at the latest investment numbers in Q1, they're actually quite high. They're about 34.7%, if I remember correctly, very close to the peak real investment, real GDP numbers in FY12, which was about 35%. But if you look at the nominal numbers, and again, go back to the left slide and look at the red line, that is slightly lower than the blue line. That would suggest that, and I suspect that is probably a little more accurate. There's some issues with the deflator that even I don't completely understand, but that would suggest that if you look at nominal investment shares, that would suggest that, that some of this private capex, which is about 35% of all capex, total capex, may be a bit lackluster at the moment, and therefore it's driving that slightly lower amount. So there are two views on this, based on either real shares or nominal shares. It just depends on how you want to look at it. Okay, next slide, please. This is a paper that we've recently done, but I'll just pose this as another challenge, is that if you also look at household savings rates, right? So there are gross rates and net rates. The gross savings rates for household savings is not adjusting for liabilities that households take on, and the net rates adjust for liabilities that households take on. But in the left slide, what we observe is that gross savings as a percentage of GDP, and this is, I think, is a bit of a worry, has also been falling since the great financial crisis. And this is going to be a challenge on how to finance investment and so on going forward, because this is a major chunk of investment is essentially financed by household financial savings. The biggest chunk of savings, and I know maybe Shishir is going to talk a little bit about this later on. Next slide, please. Now, net FDI, which is the black line, is also declining. And in the balance of payments, I'll talk about this as we go forward. You see the black line there, so there's FDI coming in, and most FDI coming into India is not greenfield investment. It's typically, so I think the way it works is that if you acquire more than a 10% equity stake, then that becomes FDI equity, and then so what I suspect, and this is just talking to people here, is that the reason why the repatriation is high, which is why the net FDI is getting lowered, is because big equity investments that happened many years ago are probably reversing their positions now. Now, whether they are reversing it because they made a lot of money and they're exiting, I'm not sure. Or whether they're reversing because they think the economy is slowing down, we're not sure. But that could be one reason why the outward FDI is high, and therefore the net FDI is becoming lower. This is, by the way, purely speculative. It's just a possible, but it does, when you look at the BOP now and you look at net FDI entries into the BOP, this has implications for the balance of payments. I'll just make one observation here, is that if you did have higher net FDI, you would needle up growth quite a bit. I would say you would needle up growth quite a bit. So this is something important from a policy standpoint to push it as much as possible. Next slide, please. Okay, let's get to international trade. This is international trade. By the way, this is in nominal. So there is a moderate recovery in Q1 FY25, which is about 5.9% compared to Q1 FY24. So that was for exports, but in Q2, there's a decline of minus 3.88%, and possibly due to weak demand in global markets. And also, India is a big exporter of refined petroleum products, but it is also an importer of crude. And when you have lower petroleum prices, that's going to have a bearing on your exports and your imports. I will just say, as I said in the beginning, is that the October indicators, for some indicators we have some data. In October 2024, the most recent month for which we have data, merchandise exports grew by 17.23%. That's a very high rate. Now the question is, if you take out petroleum products, how much is that growth? I think it becomes high single digits. That's still respectable. But there's been some reversal in the October numbers relative to the Q2 contraction in nominal export growth. Also, these movements need to be seen in context of the moderation in world GDP growth, which is projected to be about 3.2%, both in 24 and 25. Global merchandise trade in real terms has also declined about 1.2% in 2023. So these are, you're kind of conducting international trade in a world environment which is seeing slowing merchandise trade in real terms. Next slide, please. This just makes the point that our merchandise exports are biggest chunk tends to be petroleum and crude products. Next slide, please. And then it also tends to be merchandise imports. I want to make a broad point here that once the Trump administration comes in, and if it is the case that it is going to raise tariffs on China, what some countries may be able to do is, like what Vietnam is doing, is be able to import from China and directly export to the United States. And those are called connector countries. And that's an opportunity for India in this climate, is that they could serve this role as a connector country because they could then, if they import, then they could export to the United States. And I will show some work by my colleague at IIG at the moment that suggests that this could be one silver lining in this kind of climate. Next slide, please. This is the merchandise trade balance as a percentage of GDP. It's moderated somewhat to about, this is again using most recent data, to about -6, -7% of GDP. Next slide, please. Services, of course, is a different picture. So services growth in Q1, April to June, increased by 9.79%. In Q2, FY25, it increased by 12.16%. So there is resilience in service exports, again in nominal terms, and the trade surplus in services has gone up to $44.67 billion from $39.73 billion. The trade deficit in the merchandise trade account has gone up, that's a minus, from minus $63.41 billion to minus $74.10 billion. So you have a widening of the merchandise trade deficit, but you have an increasing of the services surplus. Not completely offsetting it, but it is. Next slide, please. And then you see, of course, the invisibles balance in the positive territory, and it's going up. Next slide, please. And the current account is just this. Of course, it's the trade deficit, the merchandise trade deficit, and adjusting for primary and secondary income, and the current account deficit looks manageable. And I'll, again, as a point I'll make, and I hope I have enough time, is that the economy from the external side looks quite resilient, but then once the administration in the United States changes, I think we should maybe possibly discuss this in the discussion afterwards. Is it may put some pressure on capital outflows and therefore put some pressure on the exchange rate going forward. Okay, next slide, please. And this is the point I was making about the role that countries can play as connector countries. So these are countries that will, because China is going to possibly get tariffs of about 60%, countries like Vietnam and India could essentially import from China and export to the United States, and this could be a silver lining for EMEs like India. Next slide, please. And this is just saying that if you look at the import and export of crude, so import of Russian crude and exports to refined oil products to the EU, until the Russia-Ukraine war, this was fairly low. This is the vertical line in the middle. And then after that, you pick up. So this could also be, one possible way in which, which India can potentially connect to trade blocks. So petroleum products is going to be a kind of important export and importing item. And then, there's an issue of how diversified our export basket is and so on. Okay, next slide, please. So that's the trade side. Let me summarize quickly on the trade side. So there's been a decline in Q2 of nominal export growth on exports. There's been an uptick in service exports in Q2, and the current account looks manageable. Now, on the government expenditure and public debt slide, next slide, please. I'll make some broad observations. I'll show the public sector borrowing requirement, but what we see is that the public sector borrowing requirement in FY25 is expected to ease to its lowest value since FY19. Now, there's a possible upside risk to this because the government has been saying that it plans to cap its fiscal deficit to GDP ratio at about 4.5%. And I'll show you some simulations that we've done. The other observation I want to make is that central government capex needs to grow more than 50%, according to one source, in H2 to reach budget estimate targets. And then this is an issue about why government capex is low. Is it elections? Has the economy hit capacity constraints? I think the capacity utilization numbers are quite high. So maybe the absorptive capacity of the economy to take in this capex is not there. But a broad observation I want to make is that in the run-up to COVID and after COVID, sovereign debt levels across many EMEs was high, as it was in the case of India. Under inflation targeting, where on average the central bank targets an inflation of 4%, the burden of bringing this ratio down is going to fall largely on growth because the finance ministry correctly is focused on keeping the deficit in a proper range. And I will give you some numbers here on what growth rates need to be to bring debt to GDP ratios down. Next slide, please. Before I do that, this is just the public sector borrowing requirement as a percentage of GDP. So the point I was making is that it's declining to about 8.3% from 8.1%, what it was in FY19, and this is just breaking up the state deficits, the center deficits, as well as the CPSC, the public sector enterprise borrowing. So you see this kind of, a dip. Next slide, please. This is total liabilities. These are items on the consolidated fund, but also on the public account. For general debt just means state and local. So you see this. So the dotted line below is just items on the consolidated fund, and then if you add the items on the public account, you're going to get the black line. These are total liabilities for both centers and states as a share of GDP from 1981 to 2023. Again, this shows a broad increase, and then after COVID, where it hits about 90%, it's beginning to correct. Next slide, please. Interest payments to revenue receipts. Again, so once you have gross tax revenues and you devolve and you have net tax revenues and you add non-debt capital receipts, you get revenue receipts. And then if you look at interest payments as a percentage of this, it's been rising. But a remarkable takeaway from this is of our revenue receipts, roughly 1/4 is spent on interest payments, on outstanding debt. It's very large. And these are calculations based on a recent EPW paper that we just finished as part of the special budget issue that came out in September 2024. Next slide, please. Now, here are some simple simulations on reducing public debt. If you take, and what we have here is that 1982, 1991, the leftmost column is what the debt to GDP India, by the way, this is just central debt, what it was in these years, and the end year is what it was roughly 9 to 10 years afterwards. So if you take the first 1982 to 1991 row, starting debt to GDPs were 34.4%. It ended in 1991. That's 1991 to about 41.6%. The change was 7.2%. Now, you decompose this change. It was driven by 4 things. It was driven by changes in the nominal interest rate. It was driven by changes in the inflation rate. It was driven by changes in the growth rate, and it was driven by changes in the deficit. The nominal interest rate would push up this number. The growth rates would reduce this number. Inflation would reduce this number, and the deficits would push up this number, right? So across these time periods, what we see is that inflation has a big role. In fact, in many of these sub-periods, it has the largest role in reducing public debt. Under inflation targeting, that tool is not available anymore because inflation is constrained to be on average 4%. Therefore, and with the government's fiscal consolidation efforts, which is good, the burden of reducing debt is going to lie on growth. It's going to lie on growth. And next slide, please. What we show is that, so let's just take the growth rate required to meet debt targets. So the 73% is general debt, state and center. So we're going from, this is based on simulations from the NKSing report. let's say 73 to 60, that's a 13% change. Assuming an inflation rate of 4%, assuming that the nominal GSEC rate is about 6.5%, it is about 6.75% right now. Assuming that the primary deficit averages 2.5%, let's say over these, this is a 5-year time period, what would the growth rate on average need to be to bring debt to GDP down from 73 to 60%? We show it has to be about 10%. Real terms. It's a very high growth rate. If you stretch the horizon by 5 more years, you go from 23 to 32, you have to still have a growth rate of about 8.46%. If you relax your inflation target and you raise the inflation to about 5%, you still need a high growth rate. You still need 9.19%. Again, these are instructive. This is not to be taken literally. 9.19% real growth rates versus 7.44% for a 10-year horizon. And if you just look at union debt, again, if you look at the growth column, the growth rates are fairly high. So there's no escaping the fact that bringing public debt down is going to require high growth rates. I should mention that these growth rates are higher than the average growth rates that India has experienced in the last 3 years. India's experienced high growth rates in the last 3 years, but it'll become imperative to sustain these growth rates if we want to bring debt to GDP down. Next slide, please. Now, I'll quickly run through a variety of indicators on the supply side. So first, here are some observations on agriculture. So agriculture GVA in the last 5 years has been 4.19% growth in FY23. FY23, it was about 1.44%. So in Q1 FY25, and we also have the first advanced estimates, I think, that came out on November 5, you see an increase in real GVA growth, over the past 5 years. But you see, I mean, it's increasing, but the rate of growth at which it is increasing is decreasing. So that's one observation. And then across Kharif pulses, for instance, we see a marginal reduction in Kharif pulses driven by a reduction in the area under pulse crops. That also is consistent with some inflation in that segment. You see inflation pressures in pulses, vegetables, and these things I expect to normalize in the winter months. We've had an above normal monsoon in FY25, which will help control food prices. On industry, most indicators remain positive, although in the recent data that we have available, we see a slowdown. And then, of course, in the service sector, the indicators are mixed. But for many of the broad service sectors that I'll show in a second, we see a flattening out of trend growth in the past few quarters. Next slide, please. Next slide, please. So this is the agricultural sector. And what you see in the blue bars is the share of agriculture in GVA, total GVA. So it's gone from about 15%, 1920 pre-COVID to about 14.52%. And this is real GVA growth of the agricultural sector, and it has been falling. So this is based on annual data. And then if you just look at the Q1 real GVA growth, so this is just plotting Q1 2021, Q1 21-22 real GVA agriculture, you see a declining trend in Q1 real GVA for agriculture. Next slide, please. Now, the temporal distribution of rainfall is much better this year compared to last year. Out of 36 meteorological divisions, 12 had excess, 21 had normal rainfall, and only 3 had deficient rainfall. And so the spatial distribution, and that's the red line on top, shows a substantial improvement in the rainfall distribution. But of course, in the agricultural sector, the excess rainfall can also be a problem, as well as deficient rainfall can also be a problem. So it can go either way. Next slide, please. And this just says that of the 36 meteorological divisions, these 21 plus 12, which experience excess and normal rainfall, is about as high as it's been compared to this data that we have from 2021, and certainly it's bigger than 23-24. Next slide, please. And then this just lists the area plus output of key Kharif crop yields. And as of November 5, you see, for instance, in Kharif rice, you see a 5.89% increase. Both in the you have an increase in the area, but an increase in the output. Kharif oilseeds has gone up. Kharif pulses sees a marginal reduction in the area under cultivation. Cotton sees a decline, and sugarcane sees a decline. So this is the most recent data that we have available as of November 5. Next slide, please. And these are the inflation trends in agriculture, and this is just looking at data between April to October for each of these years. If you look at data from April to October for each of these years, the change in 24-25 over 23-24, for instance, for pulses is about 18.6%, vegetables is about 14.5%, and so on. So you see, pulses inflation to be quite high. You see vegetable inflation to be quite high, which I expect to normalize in the next few months in the winter seasons, as typically happens. Next slide, please. And then now moving to industry, you see the contraction in GVA growth. Again, I've taken this a little far back because you get to see the trends. And if you look at the last three quarters, you see a decline in the trend of real GVA industry growth for India. So next slide, please. Now, index of industrial production. So here, if you look at the general IIP, that is the I think that is the last line, yeah, the yellowish line. You see it slightly tapering off. And then again, for everything. For mining, you see electricity, you see a slight tapering. For mining, you see a slight tapering. And for both the yellow and red lines, which is the general and manufacturing, you see a flatlining of IIP trends. Next slide, please. And then the growth in industrial production here, this is looking at year-on-year growth for IIP in 8 core industries. The blue line is the IIP for these core industries sees a tapering. Sorry, the orange line is the growth rate. It sees a decline and then a slight increase. And for the core industries, it's just the index value. But the index value is declining. But you do see a slight correction from August 24 onwards in the IIP for these 8 core industries. Next slide, please. And then for the use-based classification, again, this is hard to see, but again, at the very end, you see some dipping in some of the series. You see it for capital goods, you see it for infrastructure and construction goods, and so on. I'm sorry, this slide is a bit busy, but you do see some flatlining and some tapering of these series. Next slide, please. And we see a little bit of a decline in business sentiments in the July-September period here, which is going to show up in industrial production and so on. Okay, next slide, please. Now, in services, as I mentioned in the summary to this particular section, you see a flatlining across 3 broad groups in the service sector. So the purple line is the trade, hotel, transportation, communication. So that's by the way, largely an informal sector. So, and then, of course, there's finance, insurance, and real estate, FIRE, that's the red line. And then there is public administration, defense, and other services. And that is the kind of brownish line. But relative to 22-23, you see this growth in GVA and service sectors, and this is real GVA, is flatlining here as well. Next slide, please. And here, if you look at the share of GVA within the service sector, you see a decline in the trade hotel part. You see a rise in the finance, insurance, real estate part. And the smallest part, of course, is public administration, defense, and other services. Next slide, please. And then if you look at the share of employment within these sectors, the bulk of employment, and this is informal employment, maybe close to 80 to 90%, is in this trade, hotel, retail kind of sector here. This is just more for your information. Next slide, please. Now, here's a preview of a few high-frequency indicators. So tourist arrivals, based on the most frequent data, seem to be falling. So that's the orange line. Next slide, please. You see a mixed performance in cargo at major ports and freight at airports. So freight at airports seems to be falling marginally. Cargo at major ports seems to be increasing a little bit. Next slide, please. Aircraft and passenger movements. We all read a remarkable statistic in the newspapers a few days ago that something close to 500,000 people traveled by air very recently. But in terms of the data, it could be the growth rates are low because of those high bases. So you're actually looking at low growth relative to that very high level. But that seems to be flatlining. And next slide, please. If you look at telecom and internet subscriptions, this seems to be going going up. Okay, and this is just a small. I mean, I could have said a lot more here, but for the constraint on time, I'm just giving you a few high frequency indicators for which we have some numbers.
Real or growth?
This is telecom and internet subscriptions. Number, volumes. These are volumes. Yeah, year-on-year change on volumes. Okay, next slide, please. And then this is based on research done by Pavan Gopalakrishnan and his co-authors. I won't have much time to talk about this, but this is calculating the effective tax on capital. What we observe here is that the effective tax on capital in the industrial sector tends to be higher than the service sector in India. And they do a fairly comprehensive calculation of this from 2001. This is published in EPW, saying that the tax rates on capital are slightly lower in the service sector compared to industry. So if you want industry to pick up, one policy implication may be is to reduce these effective taxes on capital. Next slide, please. Okay, now on the unemployment rate, am I doing okay on time?
Okay.
Okay, so I've got, I'll zip through this. Yeah. Few observations, as I said in the beginning, is that what we see is that self-employment is the predominant form of employment in the Indian economy. And the increase in self-employment seems to be driven by an increase in female self-employment. And this seems to be a strong rural phenomenon. So, for instance, the female self-employment rates, and this is, we're using PLFS here. Now, there's a difference in unemployment if you use CMIE. In PLFS, you can use the current weekly status, or you can use the usual principal and subsidiary status. Now, the current weekly status has a reference rate of 1 week. So you basically ask somebody, were you working in the last week, right? So you may not have found a job in the last week. But if your reference period is longer, if your reference period is looking back longer, as would be in the usual principal subsidiary status, you are likely to have found work. Therefore, what you find in unemployment rates is that when you use UPSS, the unemployment rates are lower compared to current weekly status. But then, of course, when you use CMI's data, which happens in 3 waves during the year, then they are asked a particular question: are you willing to work, and are you working? So there's a completely different calculation of the unemployment rate. So the broad takeaway here is that the self-employment rates have gone up. Especially for female self-employment, it's gone up to about 57.8% in 2017-18 to about 73.5% in 23-24. Next slide, please. This is in the paper. I will talk a little bit about how we have different definitions of unemployment. Next slide, please. And then this is the employment share in major sectors. So as you would expect, employment is a relatively slow-moving variable in terms of long-run trends, but if you look at these 3 breakups between agriculture, industry, and services, agriculture employment tends to be the largest, industry share tends to be the smallest, and it's gone roughly stayed flat in the last 6-7 years. And again, in services, it's also roughly flat. So these are roughly flat. Next slide, please. And the types of employment, again, here is that self-employment, as I was highlighting in the beginning, has gone up in 23-24 to about 58.5%. Irregular wage employment in the economy seems to have slightly dipped from 22.8 to 21.7%. And casual labor tends to, which is construction. The construction sector, for instance, is predominantly casual. It's about 70% of the employment in the construction sector is casual. And there's a remarkable thing that happens because of that, which I'll show shortly. But you see a slight decline in trend in casual employment as well in the economy. Next slide, please. Now, these are the 2 unemployment rates calculated by my colleague at IIG, Gautam Kumar Das, that suggests that the unemployment rates, if you took CMI's data, is going to be higher than what you would get if you used PLFS. And as I said, PLFS is calculating employment rates based on your usual status, principal or subsidiary, and we're not looking at current weekly status here, right? We're just using at usual status. So both the rural and urban rates, unemployment rates show a decline. So for the rural, and those numbers are there, 2.49 versus 5.10, 5.10, and the weighted average is about somewhere in the mid 3. So now this is consistent. I've not mentioned this before, but earlier on, in March 2023, what we estimate is that the economy's output gap is closed. And if the output gap is closed, that's likely to suggest that growth rates are going to slow down. So the decline in unemployment rates is broadly consistent with an economy whose output gap is closed. But then again, there's this definitional feature of this which needs to be put in perspective. Next slide, please. This is again based on recent work. So what we find based on Clem's data is that when the economy picks up, regular employment tends to pick up. Casual employment tends to fall. So what seems to be happening within firms is that when the economy picks up, they begin to hire more regular workers and they begin to maybe demand fewer casual employment. But we find no statistically significant correlation in self-employment with the cycle of the economy. It doesn't seem to matter, cyclically, whether the economy is in an upswing or a downswing as regards to self-employment. This is when we don't have the construction sector in the economy. Now, next slide, please. When we add the construction sector into the economy, we get a complete reversal. When the economy picks up, regular employment picks up fairly strongly. If you look at the correlations, they're about 0.8. Casual employment now completely reverses from 0.91 to about, previously it was negative, suggesting that in an upswing of the cycle, there's also, when construction is added, it seems to be that higher incomes maybe translate into more demand for housing. More demand for housing translates into more demand for construction labor, and the majority of construction labor is casual employment. So you get this increase in casual employment, but once again, self-employment is insignificant in the data. So there's no statistically significant relationship between the cycle and the amount of self-employment that is being demanded or not in the economy. Next slide, please. And these are just labor force participation rates. Next slide, please. This is, again, done by my colleague Gautam Das, carefully constructed unemployment rates for male, female, urban, and rural. The orange line at the bottom is 2.13%, and that is the female rural unemployment rate, and it ranges essentially from 7 to 2.3%. And again, earlier on when I mentioned that consumption momentum was slowing down, I think there's a mixed picture between rural consumption and urban consumption. I think rural consumption, at least based on high frequency data, seems to be better than urban consumption. And urban consumption may be falling partly because of high inflation and so on. So anyway, these are the latest unemployment numbers from 23-24. Next slide, please. But what is driving this unemployment rate is a gray line. Look at the gray line. It's the female rural urban self-employment is quite high. It is about, if you look at that gray line on top, it is close to 73.5%. So this is essentially self-employment by females in the rural sector is high. Next slide, please. And again, self-employment is broken up between own-account workers and employers. Own-account workers, by the way, gig employment is also included in all of this. But you see in this orange line on top, if you look at unpaid family work. Now, so self-employment is rising, and is self-employment going towards paid work or unpaid work? Over time, what we see is that the proportion of female self-employment in unpaid work, rural, is fairly high. So what we seem to be getting from the labor market is that the increase in self-employment is driving the decline in unemployment. And the type of self-employment that is, at least in a maybe long-run sense, seems to be being availed of is in an unpaid family worker type of activity. Okay, that's very interesting for research, and it needs understanding why this is the case. Okay, next slide. Then on what is again positive here is that you see that of regular workers, the proportion of workers who are receiving all benefits, all three benefits. So this is Provident Fund, gratuity, and so on, leave encashment, variety. I think these are the three particular definitions. But what you see is a larger share of them have contracts where they're availing of these three types of benefits. Next slide, please. Next slide. Let's move on. Next slide. So on the policy front, there's been remarkable progress on the twin balance sheet problem. And this is all kudos to all the hard work the Reserve Bank of India has done over the last decade, and I'm sure the discussants will talk a little bit about this, but you see non-performing assets as a percentage of total assets having fallen. Of course, as you know, between 2010 and 2014, there was a period of regulatory forbearance, and then, of course, there was an asset quality review, which led to a level shift in NPAs, and then, of course, we had the NBFC boom-bust cycle in 17-18, and then, which I suspect is, I think, as I say in the paper, that the NBFC, and just talking to people, balance sheets are in a much better position now, and we're unlikely to see these types of boom-bust cycles, maybe in the near future. But lending by NBFCs is a variable that we should be tracking as a possible indicator of a slowdown, because if that lending by NBFCs is subdued, and it's because borrowing by NBFCs from banks is subdued, and that's going to play out in credit growth. But substantial progress on the twin balance sheet problem. This is gross NPAs and net NPAs. Next slide, please. I'll now try and wrap up in the last 5 minutes. So this is looking at inflation. So India adopted inflation targeting in 2016. I will show you the core inflation numbers, and this is a bit of a puzzle at the moment, which we may want to discuss in the discussion. But what we estimate using a very simple filter is that the output gap for the economy closes in March 2023. And this could be one reason to expect slower growth. And the reason why core inflation may be subdued is because of suppressed demand conditions in the economy. Next slide, please. Now, inflation targeting moved real policy repo rates from the negative region, as you can see in the 12, 13, 13, 14 region, to a positive region. Inflation was very high in the beginning of the 2010s, as you all know. And as we move towards implementing inflation targeting, first de facto and then de jure in 2016, after the signing of the Monetary Policy Framework Agreement in 2015, you see real repo rates moving into a positive territory. And if you look at the performance of, next slide please, headline core inflation from 2012 to October 2024, inflation was roughly 7.3% from January 12 to about August 16. In the first MPC, it was about 4.2%. And subsequently during COVID, which has been a challenging period, it's been about 5.7%. Okay, that's just the progression of how inflation has been. Next slide, please. Inflationary expectations. So this is again a puzzle. In all inflationary expectations data is that the actual inflation data is lower than what people expect 1 year ahead, both in terms of mean inflationary expectations and median inflationary expectations. And that's because the current assessment by people on what they expect 1 year ahead, the current assessment of what actual inflation is at the moment tends to be high. So when people think 1 year ahead, if their current assessment is high, the 1 year ahead inflationary expectations tends to be high. But they broadly line up in terms of trends. So inflationary expectations have been a bit above the current assessment, the actual inflation numbers. This gap's about 4.5%. But again, it follows the inflationary expectation number. Now, on core inflation, next slide, please. There's a debate in India about whether the appropriate nominal anchor should be core inflation or headline inflation. Let me just say that core inflation is 47% of roughly headline inflation. And since 2016, and core inflation here is this greenish bar that you can see. This is breaking up headline inflation between all its components. Headline is the black line, core is the green bar, fuel is the purple bar, and food is the bluish bar, okay? And this is tracking each of those components, and the black line gives you the final headline number. So what we find is that core inflation has contributed on average of about 2.4% of headline inflation. So on average, this tends to be about 55% of the contribution of overall inflation. Next slide, please. And this is where core inflation has declined across these different MPC periods. So again, core inflation was about 4.7%. Sorry, this is not across the MPC period. So this is until April 20, and then during COVID, core inflation rises. Now, the puzzling thing is that core inflation is falling, and core inflation typically is a proxy for demand conditions in the economy. So this could be consistent with the notion that these cyclical indicators that are proxies for demand are also on the slightly declining slide. Okay, next slide, please. And that's this puzzle. So this is the output gap of the economy. So in March 2023, so if you look at March 23 and you take a vertical line up and look at the purple line and read off to the right axis, you'll get a 0.0. In other words, the economy has closed the output gap after COVID. And then it's moved slightly to about 2.5% of GDP. Now, why is it that the economy has, has closed the output gap? Again, this is very preliminary. I've used a simple filter here. But one reason could be either that, these demand conditions have not still played out in the calculation of the output gap and will with a lag. And one possible reasoning for this decline in core inflation could be that this decline in momentum on some of the other indicators. Okay. Next slide, please. Okay, finally, I'll just end by external resilience. Next slide, please. So what we show in some recent research is that significant financial shocks for India are global financial shocks. Because financial crises have, give a strong incentive for central banks to self-insure, the Reserve Bank of India has accumulated a lot of foreign exchange reserves. Now, unlike other central banks, India does not declare the proportion of its reserves between liquid and non-liquid assets. So we don't know what that is, but we do know what the gold proportion is, and we do know what the SDR plus reserve tranche proportion is. And then, of course, India has recently been included into one global bond index and will shortly be included into another one. Next slide, please. So this is the balance of payments as things stand. And if you look at the current account as a percentage of GDP, it is fairly moderate. It's been -2, -0.9, 0.8 in some years. It's positive 22, 23. It's again -1.2 deficit, -1.9, and then a -0.7. But what I want to draw your attention to is the net FDI, which again is going down to about 10. And again, this is the point I wanted to make about maybe there's been a repatriation of profits by big equity investment firms who have pulled money out either because they've made a lot of money or because we don't know. So that's partly why that repatriation is happening. But the CAD plus FDI again is seen as a more stable type of flow, provides some offset. In some years it's provided a complete offset, but because the net FDI has been low, the ability for the FDI to provide that offset is relatively lower, as shown in 23 and 2024. But the balance of payments, I don't really see any significant balance of payment risks. Again, we can talk about this in the discussion about what may be the consequences of a new administration coming into the United States. Next slide, please. This is just a slide of our foreign exchange reserves on the external resilience front. Reserve Bank of India has something to the order of $670 billion. We calculate the average annual growth rate to be about, compound growth rate to be about 16%. 3.4% of this is in SDRs, plus India's reserve tranche position, and roughly 9% of this is held in gold. So this is a big number, and the Reserve Bank of India has accumulated reserves. Next. The point I was making about significant financial shocks being global shocks can be seen in two proxies of uncertainty. There's CBOE VIX, which is the greenish line, and then there's the black line, which is the Bloomberg implied volatility on US dollar and Indian rupee option rates. But where you see the green line higher than the darkish line suggests that the global uncertainty for that particular time period is higher than the local proxy for uncertainty. And we see that around the great financial crisis where they're both high. But in COVID around May 20, again, you see the CBOE VIX higher than the implied volatility using the Bloomberg proxy. But interestingly, in the taper tantrum, you see the implied volatility to be higher than the CBOE VIX. Okay, in other words, the taper tantrum affected the fragile five, and it was localized to a set of economies whose macro fundamentals were not good at that point. And then, of course, so that's why you see the CBOE VIX to be the green line to be higher. So the biggest spikes are driven by these proxies for global uncertainty, which is the CBOE VIX, compared to this implied volatility. But where there's been resilience, next slide, please, is that this is just looking at a series of episodes where there were large gross portfolio outflows. So 8, 9 was the GFC, 11 was the European debt crisis, 13 was, of course, the taper tantrum, 18 was the US Fed hike, 2020 was COVID, and 21, 22 was the Russian war. So we calculate where and over how many months there were gross portfolio outflows in terms of debt and equity, right? And they lasted the following months, as you can see. For 7 months, you saw these outflows. And the cumulative outflows in those months was the third column, which you can see there. But as a fraction of reserves, you see a somewhat some stabilizing. I don't have here, but it is in the paper, is that we also calculate the peak depreciation rates across these episodes and show that the peak depreciation rates are much lower as we move down to every successive crisis. In other words, reserves has allowed the Reserve Bank of India to manage these unwieldy changes in the exchange rate as across these different crises. Next slide, please. So I'm just going to end with some implications for structural reforms. Next slide, please. That there's a large debate on inflation targeting, and the Monetary Policy Framework Agreement, for instance, was extended in 2021. So even since 2016, we don't see negative output caps. If inflation targeting was seen as something that was being restrictive, we don't see negative output caps. That would suggest that inflation targeting hasn't had that effect that possibly people thought. The challenge, of course, is how to think about second-generation reforms, given that many of the key reforms that are required in factor inputs or factor input reforms are in the domain of the states. Issues like geoeconomic fragmentation, jobs and skilling, dealing with AI. I have a big kind of section in the paper where I talk about all of this. If you're moving from, industrial policy where protections essentially provided through trade restrictions and subsidies, but now move towards more FDI-friendly, maybe ease of doing business type of reforms, these can be, important avenues for structural reforms. And of course, there's an issue of jobs and skilling and what percentage of and here key is going to be really what percentage of our workforce has tertiary education, number one. Number two, and if they do have tertiary education, do they have the skills to deal with a modern economy? And that's going to be very, very important going forward in the jobs and kind of skilling front, and I'm happy to talk about this in more detail going forward. Last slide, please. Yes, one more. So just very briefly, current assessment is that inflation has just exceeded the 6% number. It's likely to moderate in the coming months. Growth is likely to slow in Q2 FY25, and I think there's broad agreement on this. I've talked to a lot of private sector market economists and everyone seems to suggest this is the case. The external sector through the CAD and BOP don't suggest there are too many risks, but I do think that this resilience will be tested in the new Trump administration policies. So in terms of a projection here, FY25 growth is likely to be in the 6.5 to 7% range. In the beginning of the year, I think the consensus would have been about 7%. But I think here it's about 6.5 to 7%, possibly in the middle of the range. And we need structural reforms to raise productivity. I just mentioned that I want to thank, in particular, several people. Pavan Gopalakrishnan at the Reserve Bank of India helped me with a lot of the slides. Gautam Kumar Das, who helped with inputs on the service sector section. Rahul, who helped with inputs on the trade section. Prakash Atre on the agricultural section. Sandhya Garg on the finance side. And Sukdeep Sim on the industrial side. These are all colleagues at IIG who put in a lot of hard work into making this presentation possible. So I want to thank all of them, and I'll end there. Thank you.
Thank you very much. What a masterly overview of the Indian economy from all possible aspects. Nevertheless, it was a sobering perspective. Growth slowing, inflation exceeding, external risks not very high but still there. You talked about the output gap having been closed but not yet negative, so where is the worry about inflation targeting there? Also, you raised a very important issue about the FDI, net FDI flows coming down, which will have a very negative impact on the overall growth prospects. So I think there's a lot on which the two discussions can mull over. So without, and thank you once again for this detailed presentation. Dr. Sengupta, please.
Thank you so much. I'm just going to use one microphone. I think that's enough. Thank you so much to the organizers. Tete is not here, I think, for inviting me to this event. This is my first time at this event, and it's an absolute pleasure and honor to be here. And of course, it's a tall order to go after Chetan, after that absolute masterful presentation for giving a very comprehensive picture of the Indian economy. It hasn't really left much to be said after that, but I'll try my best. So if you can please get the slideshow to go. Perfect. So can we go to the next slide? Thank you. So what I'm going to do is take a few steps back from the specific topic of the event today, which is a media review of the state of the Indian economy, and try to get a little bit of a perspective on why it is quite challenging to assess the state of the economy when it comes to India. And then Chetan did a fantastic job of presenting a whole lot of data and graphs on how the economy might be faring. I want to use a little bit of a framework to understand or to give a rationale as to why things are happening the way they're happening, right? And does that give some kind of an explanation? I could be wrong, but I think there's really something to it. And lastly, I'll end with a little bit of looking ahead, which is what all economists love to do, and then we're all proved wrong. But let's still stick to the discipline that we know so well. Okay, so assessing the state of the economy. Usually in a typical market economy, what economists would do is use the quarterly GDP data to assess the state of the economy in the short run, right? And we would also use backward-looking data after a couple of quarters or a couple of years to estimate business cycles in order to get a sense of whether the economy is on the upswing or downswing of the cycle, right? So in a short run, in a very classic Keynesian way, that's how we would get a sense of how the economy is faring. And depending upon whether the economy is slowing down, heading towards a recession, or whether it's hitting up and going towards a boom, policymakers would take certain stabilization policies to bring the economy back to what we call the trend level again. So as Chetan was saying, whether the output gap is closing down or whether it's improving, we try to get a gauge of that by looking at quarterly GDP data. We construct business cycles, and we try to see where on the cycle the economy is currently present, and then we try to get a sense of what kind of stabilization policies can be adopted. So the graph that you have here is from the US economy. You probably can't see the horizontal axis, but it's real GDP data from 1950 to the most recent period, the vertical shaded lines are recessions. So the US has very good data using which they're able to date business cycle recessions. And if I just give you a glimpse of a shorter time period, you would see the upswings and downswings much more clearly. Can we go to the next slide, please? So what happens when you're in a country like the US, when you are able to do the business cycle construction, there is also a consensus between policymakers and economists about how the economy is faring. And that makes it easier to adopt a policy because there is not much of a debate about whether there should be fiscal expansion or monetary contraction, because there is an agreement about where the economy is headed. Unfortunately, for a country like India, that's not necessarily the case. We often find that there is not enough consensus between what the policymakers think the economy is doing and what the economists think the economy is doing. And hence, there is always a debate and dispute about there's a narrative that says the economy is actually doing extremely well, but then there is data that's pointing that no, but that's not necessarily true. And economists would try to say, but there are enough reasons to believe the economy is slowing down. And then there is always this contradiction about what policy to be adopted. So, for example, if you're following the RBI Monetary Policy Committee meetings, the RBI is holding on to the interest rate because they think inflation is high, and they still think growth is quite robust and resilient, and there is not enough need to cut interest rate. But there is enough noise from the rest of the economy and other policymakers saying, no, there is enough reason for the RBI to start cutting interest rate because demand is slowing down. So that consensus is not there, right? So why is that the case? So one of the reasons is that if you look at the official national income accounts data in India, what happened was in 2015, the Central Statistical Office introduced a new GDP series with the base year of 2011-12, as a result of which the old GDP series with the base year of 2004-5 was discontinued, right? And that means that we no longer have a very long time series of GDP data using which we can construct business cycles to get a sense of where the economy was at any point of time, either in the past. And that's also because when the new GDP series was introduced, there was significant methodological change that was brought about, which makes the two series uncomparable. And hence, we don't have that long time series that economists would need, like in the US, to construct the business cycle to get a sense of how the economy is faring. And also in the current period, it becomes problematic because there are serious measurement issues in the new GDP series, and enough has been written and documented about it. I'm not going to go into it, of course. I myself have done a lot of work on it. Professor Nagaraj has done a lot of work on it, and many other economists and statisticians have written on this. So, for example, there is the infamous deflator issue at any point of time. Wholesale price index is the main deflator that is used, but depending upon the fluctuations of the wholesale price index, which is influenced by global commodity prices, the real GDP growth rate could be over or underestimated, right? So, for example, now the wholesale price index inflation is going up. We are seeing the real GDP growth rate come down. Is it because of the deflator effect, or is it because the economy is slowing down? It's a little bit hard to say. And of course, as you may all know, we haven't had a base year revision in more than 12 years, which applies to GDP, which applies to consumer price index, which applies to IIP, everything that's coming out of the national income accounts data, which means that we have to be very careful about interpreting anything that we get from the GDP data and take it with a fistful of salt, not just a pinch of salt, right? Because when you haven't had a base year revision for almost 13 years, it's debatable whether GDP data is really capturing the current reality of the Indian economy. And it's extremely important to keep that in mind whenever we do any state of the economy discussion in India. Now, what has happened as a result of this loss of credibility on the part of the official statistics is a lot of economists have started using high-frequency data, which is exactly what Chetan showed you as well. Now, the problem with the high-frequency data is that, of course, there are many, many indicators, 50 to 100. They're highly volatile, right? I mean, they're fluctuating from month to month. It's extremely difficult to get an idea of any pattern looking at high-frequency indicators. And secondly, they're uncorrelated to each other. So like Chetan showed in the heat map in the first few slides, if you just look at the most recent high-frequency data, some are in green, some are in red, some are in orange, right? And if you try to get a sense of the economy just by looking at that, what you get is a very mixed picture. Some sectors are doing well, some sectors are not doing so well. So how can you really say if the economy is slowing down or whether the demand is recovering? It's very difficult, right? As a result of which, what happens is what I highlighted the problem to begin with is there's a lack of consensus increasingly between economists and the policymakers about how the Indian economy is doing. Because it depends upon who is looking at what data. It's possible that if you look at the official data, you get a certain picture. If you look at the high frequency data, you get a different picture. And this is really not very good for economy that is trying to grow at a very high rate for a long period of time, increase per capita GDP, create jobs. If you don't have a consensus about whether the economy is faring badly or good enough, how do you come up with the policies that are required, let alone the structural reforms that Chetan mentioned? Now, given that background, which I think is very important to keep in mind, can we go to the next slide, please? I want to use a framework to understand what might be going on, particularly in the last couple of years. There are enough evidence to show that private investment has been sluggish for a very long period of time. And by this, I don't just mean the last few years. It has been sluggish almost from 2011-12. We haven't seen a significant uptick in private capex investment for a very, very long time. And this gets talked about quite a lot. What has also started happening in recent times, again, enough evidence, both aggregate data and high frequency data, that private consumption is slowing down, particularly in the urban cities. What could be going on? Now, there's the framework that I would like to provoke your thoughts with. What happened in the post-COVID period was quite interesting in the Indian economy. There was an emergence of two economies inside one. And I call this, and many of my fellow economists also do this, the new economy versus the old economy. On one hand, you have the old economy, just remain on the previous slide. On one hand, you have the old economy, which essentially comprises the vast informal sector, the micro, small, and medium enterprises, and also big part of the formal sector that is not intricately tied up to the US economy. This is sort of the old economy that we knew about running up to the COVID. And large chunks of this economy have been fundamentally weakened by shocks like demonetization, goods and services tax, and of course the pandemic, right? And then you have a new economy that came up around the time of the COVID, thriving on a wave of a massive services exports boom. Let's go to the next slide. So what is this new economy about? What happened during COVID and right after COVID was that firms in the advanced economies, particularly in the US, they made plans to reorient production in two big ways. One was to reallocate manufacturing out of China to the ASEAN economies, what we read about as China plus one strategy of many multinational companies. And the second was to reallocate services out of advanced economies to India. Now, we have seen this play out already in the mid-2000s when there was a big outsourcing boom to India, but that was the traditional IT software service exports, the Infosys and the TCS of the world, and there was a big boom in the mid-2000s. This is similar but slightly different because this is also a lot about R&D. So it is not just IT software services exports, but a large chunk of R&D done by American companies have gotten outsourced to India. So the Accentures and the Goldman Sachs and the McKinseys of the world have set up huge offices employing large numbers of high-skilled workers, and these are called the global capability centers. So in the last few years, India by now has about 1,600 global capability centers, employing 1.5 to 1.75 million high-skilled workers with a revenue of $40 billion. And according to a recent study by Deloitte, currently 45 to 50% of the global GCCs are housed in India. So this was a very big phenomenon that happened in the post-COVID period, which sort of lent a huge boost to the growth that the economy experienced, right? So this was a massive, exuberant growth that we saw riding on the wave on that service sector exports. And service sector exports grew phenomenally during the last 2-3 years. And of course, this set in motion a series of events which further helped prop up the growth of the economy in multiple sectors. Because the employees employed in these GCCs, they get paid very high salaries. They're almost intricately connected to the US labor market, which continues to be very tight. So they are getting high salaries, they're buying luxury apartments, luxury homes, SUVs, procuring credit cards. So all of that, all the sectors associated with these kind of purchases started seeing a boom, particularly, as I said, service sector exports and construction. So there was a big boom in residential real estate construction as a result of this new economy that came up. Right? Let's go to the next slide. But what's happening now? In 2024, this GCC boom is now winding down. So that exuberant growth that we saw for about 3-4 years, that has softened down significantly, because it was a one-time supply chain adjustment done by firms in the advanced economies, which is now completed. And there's only that many luxury homes or SUVs you can buy or credit cards you can take. So that is tapering off substantially. And we see that in services exports. Services exports during 2022, 2023 was growing on average at about 35%. Now, year-on-year growth rate of service exports has come down to 12%. So it's slowing down quite a bit. SUV sales are down. If you look at luxury real estate, the demand has come down. So there are many pointers to show that the new economy is still growing, but it's slowing down significantly, right? And then over and above this, you layer that old economy that I talked about, that has basically been propped up by government capex and to some extent construction and general services sector. But all of that is also slowing down. So government capex has been slowing down this year. Construction, as a result of the new economy moderating, construction is slowing down to some extent. And services in general is also, the growth is waning off. So what we get as a result of this is, you have an economy that is sort of normalizing back to a moderate pace of growth. I wouldn't say like there's no alarm bell saying it's slowing down or demand or that's how it's going to be going forward. Think of it this way. Pre-COVID, the Indian economy was growing at 3.9 to 4%. That was a really low GDP growth right before the COVID pandemic happened. Pandemic was almost like an excuse. We sort of forgot about the structural problems that exist in the economy. After the pandemic, we got this huge boom because of the GCCs, the new economy. And of course, this whole boost because of reopening of the economy, the demand coming up. But now we are sort of going back to that pre-pandemic level, except we do have this new economy still purchasing stuff. So the demand is still there to some extent. But the old economy hasn't really come up in a very big way. So you get this economy that is sort of normalizing back to a moderate pace of growth. Let's go to the next slide. And this is exactly what you see in a whole bunch of high-frequency indicators as well. So even if you're not able to read the writings on the slide, let me just quickly tell you, on the top left-hand panel, you have corporate profit margins, net profit margins. And you all must have seen the news that how net profit margins of the corporate sector have been declining for 2 consecutive quarters this year. Net sales have slowed down at the fastest pace in the last 2 years. So that definitely doesn't bode very well. On the bottom left-hand corner on the left side, you have the GST growth, the red line, which is still going okay. But the black line is the growth rate in cess. And cess is basically a kind of tax that is imposed predominantly on luxury goods. The growth rate of that has been coming off quite a bit, right? This is again evidence of the new economy slowing down. Then on the right-hand side upper panel, you have the growth rate of personal bank credit. Bank credit to the retail sector had been increasing quite a bit during the last few years. That has come off because of RBI's steps and as a result of maybe high interest rates as well. But this doesn't bode very well for consumption demand going forward, because much of the consumption demand that was happening was also, unfortunately, leveraged consumption, right? Which meaning that households were borrowing to consume. That's not a very healthy consumption growth, because that means your incomes are stagnating. So you feel the need to borrow in order to consume. And that is also coming down. So it's bound to put a brake on consumption demand. And then you have the stock market correction over the last several weeks, which means that the wealth effect that was happening as a result of the stock market rally is also losing its sheen. That could be another brake on consumption, right? So let's go to the next slide. And that's my last one. So ultimately, whether it's a cyclical or structural slowdown, very difficult to say. As I said, we don't really have the kind of data that we need to understand where in the business cycle the Indian economy is positioned. My sense is it could be structural because, as I said, we had a certain slowdown happening pre-COVID. COVID was a distraction, and then you had a little bit of a change in dynamics with a K-shaped recovery, new economy and old economy. We are now sort of converging. There's a normalization happening, and it's possible that structurally Indian economy is going to continue to grow at a certain rate. I can't even comment on the number given the problems with the GDP data, but suffice it to say not a very high level of growth rate going forward, unless 2 things happen, and which is my second bullet point. The 2 main drivers of growth in any large emerging economy like India are private investment and exports. private investment, irrespective of whether the balance sheets have cleaned up, as Chetan mentioned, we don't have any NPA problem in the banking sector. The corporate balance sheets are exquisitely clean and healthy. Government has done enough capex, and the whole idea of the government capex was not just to boost the economy, but to get the private sector to invest. That was the main idea. But that's not happening. The private investment is really not picking up, no matter how much capex has gone up. So it could be a function of demand slowing down. It could be a function of the policy. There's not enough policy level playing field in the economy. It could be a fact that exports are slowing down, because investment and exports are intricately related, right? So private investment needs to pick up in order for us to grow at that high sustained level that we aim for, and exports need to pick up. Services exports slowing down but still growing. Goods exports, it's been our bane for several years now. During the pre-GFC boom period, goods exports was growing at roughly 20-25%. Now it's growing roughly at 7-8%. So when not just a global factor, but also I think what has happened is over the last several years, we have turned incredibly protectionist. Our average import tariffs have gone up from 5% to 13%, which is much higher than many of our peers in the Asian economies, which makes us uncompetitive. So if our exports are not competitive, then irrespective of the global demand, we're not going to be able to increase our export growth. And global demand slowing down, yes, we often cite that as a reason as to why our exports are not increasing. But we have to keep in mind that China is slowing down, and there is an active China plus one strategy by many MNCs that Vietnam, Bangladesh, Thailand, and Mexico have benefited from, and we have missed the bus. So it's not just global demand slowing down, it's something happening within the Indian economy in terms of the policy mix, maybe free trade agreements, protectionism, import tariffs, that we were not able to take advantage of the China One Plus strategy. And I think that's too late already. And we are basically stuck with services exports and putting all our eggs in one basket, right? So unless private investment picks up and unless goods export miraculously has a huge recovery, I really don't see what are the growth drivers going forward. Consumption is not a growth driver. Consumption is a residual. When the economy is growing and incomes are growing, people start consuming, and that sort of feeds more into the demand. But investment and exports need to grow for incomes to grow, and that is not what's happening. So with that, and this is a graph where I show the red line is net fixed assets of the listed companies in India, which is a proxy for investment that's coming down. It was a moderate increase after COVID, but nowhere close to where it used to be in the pre-GFC or even 2012-13. The green one is financial investment. So instead of investing in projects, the corporate India is investing in financial assets. So clearly they are not seeing enough returns in investing in projects. They are seeing better returns in capital gains from the financial sector. Again, not particularly a very good news for the Indian economy. So I'm just going to end with that, and I have a lot of questions for Chetan, but happy to do it later. Thank you.
Thank you. Thank you. I think I thought you would lift our spirits, but I think you have made an even more sobering presentation on the data problems, the rise of new economy, which is stabilizing and normalizing. And of course, private investment still very tepid, and exports not going to realize their true potential because of protectionism, data. So I think let me turn to Mr. Shishir Gupta. The floor is yours. Yeah.
Thank you, organizers, Malcolm and Elizabeth Trust, Mr. Srivastava, AKV, for having me here. Like Rajeswari, this is my first time here and delighted. Actually, I don't think I have anything to add after what Chetan and Rajeswari have said. And in fact, I agree in toto with Rajeswari, right? Both on where we are structurally, which doesn't seem to be very rosy, and also why we are structurally at a tepid level of growth because of a not buoyant corporate investment, which is one of the key drivers of growth that we have seen. So what I intend to do in the 10 minutes that I have, I'll pose a few questions to Chetan based on his masterful presentation, and then take you through my brief presentation on why corporates in India are not investing. Similar to, I think, what Rajeswari said, but I think I'll still like to share my 5-7 slides. So I think on Chetan, I think with my first observation is I see a slight disconnect, and maybe I didn't read it carefully, when about the conclusion of India's economic slowing down versus what the high frequency indicators for the last quarter or month were showing. Because I think we discussed that the last month was indicating more of green, and I think your demand line also shows slight uptick probably, but the conclusion is that it's the GDP growth is slowing down. So maybe I do not recall it correctly, or I find there is probably slight disconnect. Second is, I think the given the richness of the paper in terms of covering so much aspects, right, demand, supply, employment, I would encourage, right, and that would be a big service, Chetan, if you can come up with some framework to talk about, as Rajeswari said, right, I mean, how you are coming up with this conclusion of slowing down beyond the HFIs, right, high frequency indicators, since they are so volatile. Not, I think, will it help us or you guys to talk about the outlook for the near term more probably convincingly. It may also give you some lead into what is the medium term outlook, and because that I think are related, right, from a policy standpoint. So those are two observations I have on the presentation. Couple of questions. One is, I'm glad that Chetan talked about the disconnect between the investment both in real and nominal prices, right? Actually, the difference is quite stark, 4 to 5 percentage points of GDP if you look at real investment versus nominal, real being higher. And if we look at ICOR of 4 for India, 5 percentage or 4 percentage point of GDP means 1 percentage point growth difference in GDP on a structural level. So it's a big difference we have. And if you believe in nominal series, you will be slightly more mellow in your outlook, as I think I am. And if you believed in real, then you will not be, right? So Chetan, one suggestion is you talk about the difference, and I heard you talk about you more comfortable with nominal numbers. I don't see you talk about that in the paper, which is your preference for nominal and the reasons, because I think that will push the debate given the criticality of investment. And my last point is, any idea why female rural self-employment has gone up the way it has? I think there's a lot of people are talking about, uh, and I've tried to understand, but any explanation here and maybe in the paper would be very, very helpful for, I think, all of us. But again, many congratulations on putting this together. What I'm going to do now is show you guys work that I did with one of my colleagues at CSEP Rishita some time back, which essentially tries to explain why corporate, why investment is not up. And when I look at investment, I'm looking at nominal numbers, right? Because there is a disconnect. And what I conclude is that investment ups and downs are strongly correlated or driven by corporate investment. So the key question is, why is corporate investment not up, not back up to the levels it was? Because if we have an answer or somewhat of an answer, I think that gives us some footing for the tepid growth outlook that at least I have for the economy going forward. This chart shows the breakdown of investment into three components: public, private, corporate, and household. Private corporate is the key number to look at, which is in maroon or red. These are shares of GDP. So few numbers to pay attention to. The boxes at the lower panel indicate real GDP growth in these periods, annual. So the first number is between 2000 and 2004, real GDP annual growth was 5.1, and overall investment was around 30%, with corporate share at 10 to 9% of GDP. Now, key thing is the next 4 years, which is primarily the surge period of Indian economic growth. Growth was 8% per annum, real growth. Investment shot up from 30% to around 40%, led by corporate. Right, so it's the corporate investment which increased from 9 to 21%, which led to faster GDP growth. Over time, as you see, GDP growth has been hovering at around 6.5. Discount the COVID years. which we discussed in detail in Chetan's presentation. But the key thing is overall investments have come down, and again the key component that has come down is corporate investment from around 20% to around 12%, right? So the message from this chart is GDP growth has been tepid since, let's say, 2012. Investment is down, and the key component of investment that is low is corporate investment. Next slide, please. So in the paper that I did with Rishita year and a half back, this is important, okay? So corporate investment as a share of GDP, which is the metric that everyone looks at, can be broken down into two MECE components. One is how much corporates invest as a percentage of their sales, and second is how much corporate sales are a percentage of GDP. So it is important to realize, right, that investment by corporates as a percentage of GDP can go up or down by any of these or some combination of these. And typically, I think we don't make that distinction when we talk of corporate investment. Next slide, please. The leftmost chart is corporate investment to GDP ratio, and you can see, and this is from 95 to 2023, and you can see, right, during the surge growth years of 2004 to 8-9, corporate investment to GDP really surged, right, from around 5% in 2001 to close to 17-18% in 2008. And the next two panels are the two components that corporate investment can be broken up. So it is interesting that the next panel, which is shaded gray, which is how much corporates invest as a percentage of their sales, the chart actually mimics the left-hand side. So first inference is that corporate investment to GDP is quite, while it is made up of these two components on the right, it is heavily driven by the middle component, which is how much corporates decide to invest as a percentage of their sales. Having said that, in the growth periods, or let's say from in the first decade of this millennium, from 2000 to 2010, and I'm looking at the rightmost panel, corporate sales as a percentage of GDP rose significantly from around 50% to around 85%, which means that after the reforms, there was a consolidation phase in 5-7 years after reforms. And then as a result of reforms which allowed corporates to have a level playing field, their importance in Indian economy increased from 2000 to 2012-13. And that itself helped corporate investment to GDP to go up. Okay, over time, because of NPA issues, right, which affected large corporates significantly more, you see their share to GDP come down. And over time now, with new IPOs and NPA behind us, I expect corporate sales as a percentage of GDP to go up. So, few key messages. Investment to GDP is largely driven by how much corporates decide to invest as a percentage of their sales, but we cannot disregard how big are corporate sales in GDP because they are structural, and if they go up in future, which I expect them to, other things remaining constant, we might see a slight uptick in corporate investment to GDP. Next, please. So this is a regression we have done in the paper. It's again, these regressions, my background is in consulting, so please don't hold me accountable for all the right elements in a regression. This is a 20-year annual regression we have done on explaining how can we understand corporates' decision to invest as a percentage of their sales, which is the chart on the right. And we make it a function of two elements: profitability of the corporate sector, which is the first row on the left, and the growth outlook corporates have for the next period. So essentially, we say corporates decide to invest on these basis these two elements: how much profit they are making and what is their growth outlook. The key thing is that growth outlook variable is very, very significant, and the coefficient is also very high. So and the right hand side tells us that one is the red line is the actual line, how much corporates have invested, and the gray line is the estimated based on this regression. And as you can see, apart from few years, the fit is a decent fit. So it can work as something to give us indication of what is driving corporate investment. And the last point on this chart is that whatever levels of these two variables we have at present, which is how much profitability we have and what is the growth outlook we have at present, corporates are investing today consistent with that. So corporate investments are not depressed today relative to the incentives they have in terms of profitability and growth outlook. Next chart, please. So what is the situation of these two drivers today, right? Because we know, I showed you that corporate investment to GDP is around 12%. That was one of the first few slides. Then the last slide showed that corporate investments are consistent with these two variables. So on one hand, they are low, but they are not depressed. So why are they low but not depressed? The left panel shows what is the profitability. We discussed this. And the right hand is what is the growth outlook. As you can see, when corporate investments were very high in around 2008, profitability of corporates were around 9%, right? Very, very high. It is back again, and this is what people keep talking about, right? Profitability is back of the corporates. Why is investment not back as much? And the answer to our mind is on the right. As you can see, right, when corporate investment was around 20% of GDP in around 2008, not only was profitability very high, but growth outlook was around 8%. Now growth outlook is around 6.5. And we know that growth outlook plays a big role in corporates' decision to invest. So to our mind, corporate investment is not back, but is consistent with these two drivers because growth outlook is significantly lower compared to what it was in the peak years. Next slide, please. Something that Rajeswari also alluded to, which is growth outlook is heavily dependent on on our exports, right? So left-hand panel is is exports in CAGR terms, India's exports, both goods and services for these time periods. And the right panel is growth rates, again, CAGR terms for the similar periods. I mean, this is a busy chart, so just focus on the movement of the bars in terms of left and right. And what you'll see is that when export growth is high, let's say between 4 and 8, real export growth was close to 20% annual. And real GDP growth was close to 8%. Over time, exports of goods and services are coming down, and GDP growth is also moderate as we discussed. Over the last couple of years, real export growth has been around 8%, and GDP growth is 7.6, right? Now 7.9 is the last data point, sorry, to look at it, this chart is, and Rajeswari again talked about this, that our exports are a function of two things, our competitiveness and how fast is the global trade growing, right? And the bottom rectangular bars are a ratio of our export growth to world export growth. And if you can see, this ratio is consistently at around 2, right? I mean, barring, let's say, 2008 to 12, when the ratio was 4.6, where our export growth was 5 times or 4.6 times faster than global trade. This has hovered around 2, which means if global trade outlook is tepid because of global fragmentation, etc., our export growth will not do very well, other things remaining constant, and that other things remaining constant being productivity. So that is why at a structural level, our outlook is moderate to my mind, GDP growth. I'll end with my last slide. Next slide, please. This slide, so we have talked about that our exports are not as fast, and that is to do largely with global trade fragmentation. So what do we need to do to improve growth outlook? It's important to keep in mind that 55% of our exports happen through large firms. So large firms are the vehicle of exports. We are not an exception. OECD average is around 40 to 45%. But what is important is on the right-hand side, right? I mean, in terms of large firm revenue, exports make up for roughly 15% of their overall revenue. This is higher than around 9% in 1995, So large firms have started exporting more to gain revenues, their own revenues. But at 15%, this is half the share that countries like France and Korea have. So if India has to export more to improve its growth outlook in the wake of fragmented global trade outlook, its large firms need to generate a larger share of their revenue from exports. And for this, we need to have those structural reforms, which Chetan and Rajeswari both talked about. Unless we do that, I think our growth outlook will be at a structural level is I think where it is, which is around 6.5%. So I'll just end there and open to any questions. Thank you again for having me.
Thank you very much. Thank you. I think we are behind schedule going by our published program. So there's two options. One is this: if you have some questions from the floor, and then maybe at the end of it you can respond to all the points. So go ahead, please.
Chairman also have some questions.
Okay, sure. Let the chairman have the first question.
No.
Okay.
Please.
Yeah.
Please.
Yeah.
Good afternoon. First of all, my compliments for a very, very comprehensive presentation and the two supplements. And that also, what I heard was that share of manufacturing as a percentage of the GDP is declining or stagnant. And this has also resulted into some extent export of goods also stagnating or declining. And this has been despite all the aura that we have around production linked incentives, new economy versus old economy, new economy bringing in some share of microchips manufacturing, mobile phone manufacturing, electronic goods manufacturing, and old economy still continuing to be with manufacture of machinery, textile, toys, and other things. My question here is, what has really gone wrong with the MSME and the old economy, and what steps the government of India or anybody needs in order to boost up that part of the economy, which has been a core strength. Textile, for example, jute goods export have been our very good strength. Leather goods, another issue which have been good strength. So what should be done to boost up this part of the economy?
Yeah, thank you, MSM. We'll take three questions at the time. Please be brief so that all of us can.
Yeah, I think it was a great presentation, excellent. If I can get copy of that some way. I think there was a mystery in this entire lecture as to what really is pulling down the Indian economy. I think it's very simple. It's a monetary policy. I've been arguing for the past 2 years. Indian economy has become completely uncompetitive, non-competitive because of the high interest rates. If you want to be globally competitive, you have to borrow, lend money, your capital has to be raised at a reasonable rate. And you've been linking, Professor Ghate, your monetary policy to food inflation, which I think is absolutely absurd. Nobody in the history of the world has ever fought food inflation through monetary policy. Don't you think it's been extremely stupid? Last week, the commerce minister came out very strongly, and 2 days back, the finance minister came out very strongly. Was it not so evident in the past 2 years that when the core inflation is down, you can't have your interest rates high?
Yeah, thank you. Yeah.
My compliments to three presentations, very incisive, very perceptive. The question which comes to my mind is that we are aspiring to become Viksit Bharat, a developed economy by 2047, when the population of India will be about 1640 million, 820 million in urban areas, 820 million in the rural areas. But the projections of the government itself say that 75% of the GDP and also the employment will come from the urban areas and only 25% from the rural areas. Now the paradox is very clearly visible. The incomes of the per capita income in the rural areas will be 1/3 of the urban areas. So how we are addressing this kind of paradox?
Thank you very much. Let me be a leftist there. Maithili?
Thank you, AKB. Thank you to the panelists also. Chetan, I had one question for you. You said the output gap has closed, but there has been no indication of increase in capacity utilization. So how can one argue that the output gap is closed if there's no change in capacity utilization? Rajeswari, a question to you. You said that U.S. economy, the both policymakers as well as economists are agreed where we are in the business cycle, and you said great store by that. But the fact is, there's never been any agreement. In fact, the New Deal economists are still not sure of a Great Depression. They finally call it depression maybe 10 years later, and even now we've seen the U.S. saying that there is a recession, and clearly the U.S. economy is doing very well. Then two questions to all three, for which I didn't get an answer really. Is the reason why private investment has not picked up, despite the government giving tax concessions and now calling for lower interest rates, is it because the structure of the economy is also shifting a little bit more towards services, which don't require that much of investment? And also, are the corporates investing in financial assets rather than in real assets? That is one question. And the second question that I wanted to ask is that, is the slowdown in investment also because of the K-shaped recovery?
Thank you. One more observation or question, and then we come back to the panel. If you have time, we will come back for another round, okay? Please.
Chetan, you talked separately about the foreign exchange reserve position and the change of the exchange rate. Now, in the literature, you normally combine the two because these are two alternative ways that the foreign exchange market perceives pressure. So I would suggest that, I may have missed it in your presentation, but I suggest that you combine the two to get an overall measure of the pressure in the foreign exchange market.
Okay, let me now turn to Dr. Ghate and then Rajeswari. Sorry, I'm so sorry.
Good chair.
Okay, please
Okay.
go ahead.
Well, thank you very much for all your observations. First to Rajeshri's point about old versus the new economy, I think and we need a little bit of a rethink on this. The MSME sector is good for employment and good for some export growth, but it is not great for productivity growth. If you're going to raise productivity growth, which is ultimately going to matter for wages and per capita incomes, you need to have bigger firms, more exports, and so on. You'll have to raise productivity growth. So we talk a lot about the MSME sector as a possible conduit for employment. That's very important. But as I said in the very first slide, the key structural challenge is to raise productivity. Now, various questions from Shishir. I've taken all your comments on board. We'll look at the corporate investment rates again. But Rajeshri, I think you made a point that consumption is a residual, but as Shishir is showing, that corporate investments respond to growth. And I think when firms have, see high consumption demand, they're going to then begin to invest in capacity utilization. So the investment is going to come from looking at consumption demand, which will influence their capacity utilization. And on the disconnect between the high frequency indicators and the broader momentum in the economy, this is the mid-year review. So I'm scrambling to find data for July, August, and September to say something forward-looking about what Q2 is going to look like. So it's the very nature of this exercise that means that we have to put up as many high-frequency indicators as possible. And of course, there's this issue of, are they uncorrelated? Are they correlated? Is there any systematic pattern? Which is why we have this attempt to produce a demand index. Again, the way that we do it is in that paper, and we show that the demand index is tilting down. On Maitli's question, is this consistent with the output gap or not? There could be leads and lags here. Again, one puzzle is, is capacity utilization consistent with the output gap? In a broad correlation, they are very, very consistent. The correlation is very high between capacity utilization using Obicus and the output gap. It's extremely high. In any particular period, do you see that correlation high? Maybe not, but in a broad sense, you do. But Rajeshwari, to Shishir's point that if corporate investment is responding to growth outlooks, then consumption demand is going to be important for subsequent GDP growth because firms will then invest in capacity utilization, which will raise investment rates. On the issue of monetary policy, so first, the inflation rates to date, fiscal year, have been 4.8%. With a 6.5% policy rate, that's a 1.7% real policy rate. The RBI's estimate, I hope this is correct, of the real neutral rate is between 1.4 to 1.9%. The real policy rate is 1.7%. Okay, it's smack in the middle of that range. Now, if the Reserve Bank succeeds in bringing inflation, let's say, down to about 4.5%, the policy repo rate is about 6.5%. That's a 2% real repo rate. I don't think that's particularly tight, but if it is, then we'll have to see how the interest rate sensitive sectors.
No, my issue was completely different.
No, I'm addressing your side. Interest rate sensitive sectors look like, for instance, the real estate sector, and whether they slow down possibly because of this real policy rate. But to your question, should the central bank be responding to food inflation? A lot of the work that I have done, and this is, by the way, central banks that adopt inflation targeting and target core inflation have left it. They've gone back to headline inflation. And the reason why the central bank targets headline inflation is because the public understands it. The public understands what headline inflation is, and it doesn't understand what core inflation is, partly. And there are also second-round effects, that once you have persistent increases in food prices, once you have persistent increases in commodity prices, which households face the brunt of, it will very quickly feed into their inflationary expectations. Once it very quickly feeds into their inflationary expectations, that's going to start filtering into higher wages, higher prices through indexation, dearnesses, and so on. So this is not this is an active area of debate in India at the moment, but my view on this is that these second round effects are important. The Reserve Bank of India watches it. It calculates it to the best of its ability that we can. But countries that have adopted core inflation in their mandate have left it. I think Thailand is one example of that, and India is targeting headline inflation.
No, if I might, no country.
I think we'll have it later, second round.
Okay, and then finally on the range of questions about points made about WPI inflation going up and real GDP going down, that is an issue. I have to see here, but I've been trying to emphasize that the momentum in many indicators is falling. And on this point about about the old economy versus the new economy, again, I'm coming back to this. In the 2000s, we experienced a major technological revolution. This was the revolution that divorced production of services from the export of services. We were producing, we were the headquarter for firms producing IT, ES, and BPOs was in the US, maybe in Europe. But India was a big part of the back channel for the export of these services. So the production and export of these services was split up. And that was the big technology revolution that India kind of experienced. And I think where this discussion about old and new is going to come out now more starkly is through the new revolution that we will see in AI and how that's going to play out in jobs and so on. Whether it's going to displace jobs, whether it's going to be complementary to jobs, what tasks will it displace jobs in, what tasks will it be complementary in. It's clearly going to raise productivity. Productivity is going to mean that prices will fall. Prices falls means demand for products will go up. Demand for products means labor demand in those sectors will go up. That'll create employment. But it may change the task content of work, and if it changes the task content of work, it may displace people. So the final impact of this next revolution is going to be whether the displacement effect is stronger than the labor demand effect, creation effect. And in some sectors, it may displace more than it demands. In other sectors, it may demand more than it displaces. And then a point about Shishir about, I think the numbers we've put out on the female self-employment rates needs more investigation and more studying. And I don't want to be speculative here and address why that's the case, but we'll certainly think about that and add that in the paper.
Thank you. Shishir, would like to address any of the questions that were raised?
Yeah,
Yeah.
Very quickly, I don't think I have good answers to Maithili's question. Let me just give speculative ones. See, I think this is a key question. Nature of growth shifting towards services, and hence, do we need that much investment for growth? $1 million question. Maybe not in the long run, but right now we are looking at 4 or 5 years before and 4 or 5 years, I mean, current trends, right? In which it's very difficult to assume that the nature of growth and the composition of GDP has changed so much that you can grow at a significantly faster rate with similar investments. Essentially, that requires ICOR to go down significantly, but I don't think we have the evidence for that. On your first question of output gap having closed, but why capacity utilization? I think it's interesting because I was looking at capacity utilization even in between, let's say, 2010 and 20, when people were saying corporates are not investing, capacity utilization did not shoot through the roof. What does that tell us? That there was addition of capacity by corporates pretty much consistent with how much their demand was growing, right? So this notion that the corporates were not investing in that period and the capacity utilization doesn't indicate that. Lastly, capacity utilization now has seen a slight significant uptick, but it's around 75%. So my sense is, with growth outlook being what it is, it will again lead to moderate capacity utilization by or investment by corporates, so that you are at a reasonable level of capacity utilization. It will not lead to a significant corporate investment because of the reasons of tepid growth outlook. Thanks.
Thank you. So, Maithili, to your question, I think what has happened currently in the US is they haven't faced this kind of an inflation in 40 years. So that obviously has thrown things in awry that, okay, how exactly is the economy faring? But by and large, if you look at almost 60, 70 year period, Great Depression was an anomaly because that's pretty much when the national income account started. But post Second World War till now, when the inflation started rocketing, during this entire period of about 5-6 decades, there was a general consensus about how the US economy is faring, definitely more than what we are seeing in India now. Because what really strikes me as odd now is, even in India, there was a point of time when we could say whether the economy is slowing down or it's growing, whether it's booming or going into recession, but we can't say that anymore with a lot of confidence. There's a lot of conflicting narratives about how the economy is doing. And I feel that till that gets resolved, how do the policymakers even come up with what kind of policies and reforms to be undertaken? Because if you believe the economy is really doing well and we're headed towards an advanced economy by 2047, then nothing really needs to be done, right? So I think that's where it becomes a little bit problematic compared to the advanced economies. One point I would like to make on the investment thing is, I think the reason private investment is sluggish is not just one factor. It's multiple factors at different points of time, right? So even during the pre-COVID period, consumption was doing all right. But that did not trigger investment because that point of time, balance sheet crisis was a big problem the firms were dealing with. Then we had balance sheets cleaned up, but now consumption is slowing down, so there is not enough reason to invest. And simultaneously, companies will invest when there is a risk-return trade-off, when the return is greater than the risk. And I think something has shifted in the general economic environment where the risk of investing now is greater than the returns. And that's exactly why investment is not increasing. It's not at different points of time we can highlight its consumption, its exports, its global demand, its geopolitical uncertainty, its balance sheet. But by and large, the return to investment is not as high as the risk. And I think the policy mix of the country, a level playing field, if just a few guys are getting a lot of favors, all of these have a very big role to play in creating that kind of a momentum for private investment. And I'll just stop with that, but happy to talk at lunch.
I think we'll have only a second round. There's a final round because we are running out of time. So I'll start with Mr. Srivastava. Yeah.
And just a couple of short questions. I was discussing with my colleagues in DGFT as to why export is falling. Besides many reasons that they gave, one reason they gave was that we are maintaining the exchange rate artificially at a higher level. The rupee should actually be 91 rupees, not 84 what we are having. So I would like the panelists to comment on this. My second short question is on this, though Chetan alluded to this one nation, one election thing. When that committee, COVID committee submitted the report, that time some figure was mentioned that if it is done, how it is going to impact the GDP and the growth otherwise. So is there any real study done as to what kind of impact it is going to make on the economic growth? The third one is that this freebies, now it has become a rat race among the political parties all over the country. How it is impacting the economic growth? I would like the panelists to comment on this. And finally, two short things. This private investment, what Rajeswari was referring to, I would like to say here that I was definitely a part of the growth story. At that time, 2006-8 period, I was in charge of airport development. I can recall that the kind of dialogue on a continuous daily basis that was taking place between the government and the private sector, and to sort out their individual issues, I am not seeing nowadays at all. There is no dialogue virtually taking place. So I personally feel that that spirit needs to be revived if really want private investment to pick up. And my last one is, this rail reforms. We have not heard anything at all. I believe somebody had mentioned a figure that if you want to really make our railways to come up to the world standard, something like 50 lakh crores of investment is required. And it is not that this money is not available from the private sector inside and outside the country. This money can come, but unless this sector is opened up, reforms is brought in, this is not going to really materialize. And last one is the Trump effect. I would also like the panelists to comment as to what kind of effect on the Indian, export or trade is going to take place with Trump assuming office. Thank you.
One question, and then we have one question here.
Yeah, Mr. Ghate, we are talking of agriculture based on our rain or weather. Why not to take it as a climate in the whole, the way we have recently in COP29, and we have been told that $28 million are affected because of weather, climate change. Second thing is about our FDI. The way Rajesh pointed out, it's happening reverse. FDI, our own industries are going abroad and investing there instead of coming from outside, and they are playing some tricky jobs and they are making a bad image. Third thing is that investment can happen because of our big industry like semiconductor, infrastructure, defense production. And why not to be have a lesson from China, the way they have a big project of BRI and like. Thank you.
Yeah, thank you. Yes, thing.
Yes, I have a question regarding this point that, that government started this IBBI reforms, but insolvency, bankruptcy, in fact, code is declining in success. We are finding it is going to that level, where the Sarfashi Act was, and that too because of a few ticket successes, in the steel sector, it is success. Otherwise, the NPAs are on the rise. So why is it not showing in the data, And the data still is showing that, Indian NPAs are declining, and the financial sector is somewhat stable. And my second question is that our big firms are getting rent seeking, as far as monopolies are concerned, they are basically making profit out of raising inflation rather than being innovative and rather than innovating or cutting it.
Yeah, Mr. Bajaj, would you like to ask a question?
So may I ask one small observation?
Yeah, sure, please go ahead, and that's the last question.
Good afternoon, sir. It's been very interesting in discussion. I have just one observation. It's about private sector investments. When we are talking in private sector investment, the type of investment is not being analyzed anywhere. Some comment was made that between financial and productive investment. But as a former banker, I was chairman of Export-Import Bank and I've been banker. If you see in the last 10 years, a change in orientation of large corporates has happened. A large number of them have gone into reality. And whether it is Godrej, or whether the Heroes, or whether it's Tatas, they're all going into reality. In their balance sheet, such investments will come as investment. It is not going into productive investment. It will not go into export-oriented investment. This is observation number one, sir. Second is when you are analyzing exports, and especially merchant exports, we have one anomaly in India, that there are two aberrations which have happened in this thing, and that is the advent of Reliance Petroleum and SR Petroleum, which came in the early 90s, when they put up global-sized mega refineries on the Kutch coast. These are the two exceptions. After that, they have had some expansions, but the scope of their expansion is over. So they are extremely efficient, but they do only tolling. And there is no impact on the economy as such. Petroleum is imported, processed, and re-exported. So the entire impact is only in numbers, not on the economy in form of additional employment or additional demand for goods and services or for these things. If you isolate these two out from our exports and then do an analysis of how Indian exports are behaving, you might find a different picture. A third observation, sir, is
A lot of discussion has taken place on services exports, and that is very valid. But there's been no discussion or no reference at all to the remittance behavior. And Indian remittance, if you see the inward remittances, the inflow is much bigger than the FDIs. It's as big or maybe even almost as big as the FPI investments. And this is a source of as much growth impact as services. Now, how much this can grow further, or this thing with the world becoming slightly more political oriented and home inward looking everywhere, whether it's US or whether it's Europe, and whether the attitude towards migrants and jobs and these things can come under threat. These are two observations, I think, which need to be kept in mind. Thank you very much.
Let them respond.
Okay, thanks.
Whatever question.
I'll ward off some questions to Rajeswari,
sure,
so
sure,
she
sure.
can deal with the NPAs across sectors because she writes a lot on it. But so as I mentioned in the export calculations in October, we saw an increase in merchandise exports. But if you net out the petroleum products, it moves to single digits, but overall it was about 17, 18%. So that's exactly your point. But it's still a high single digit, so that's respectable. But it is not high double digits, high, and 17, 18%. So it could be specific to these particular items. And then this is, I think, also what Maithili is also saying is that, do you need high investment rates in a service sector denominated economy? I've grappled with that question for many years. I'm not sure, possibly not. Possibly not. But I will say that in the countries where we've seen high total factor productivity, it's essentially come from having high manufacturing shares, which is, I think, the point that you had made earlier on, that it is roughly flat for many years. Industry, mining, manufacturing, and electricity shares are roughly flat. But when we see high productivity growth, it has come from economies where manufacturing has increased as a share of GDA. And therefore, it's somewhat consistent with the fact that our total factor productivity growth rates are not high. So if we pursue a service sector growth strategy. We haven't talked about climate change. On FDI, I said that the net FDI may be happening because of this repatriation by big foreign equity firms who are possibly pulling out. And that's driving the numbers. Now, whether that's because they see growth slowing down or it's because they've just made a lot of money and they're leaving, as I said, most FDI in India comes through, not so much through greenfield investment, but essentially through this FDI and equity part. And climate change is going to be, I think, a huge opportunity for India to, so in the Ghate Economic Conclave that the Institute of Economic Growth organizes along with, you were there, with the Ministry of Finance, the number thrown around is that we need to be investing something to the order of 7% of our GDP in renewable investments. And right now we're investing about 1% or less than 1%. That's going to be a huge investment. So the real reforms that Mr. Srivastava, you were talking about are going to be important, how we finance it through MDBs, through some public-private partnership and so on, are details that need to be worked out. On the freebies, I agree, there's a lot of discussion. One election, one nation. My view on that is, I haven't seen that paper carefully, but it is producing a first estimate. Now, the debate should be whether it's too large or not, we don't know. But it, I guess it's produced its estimate. Now, finally, on the exchange rate, as a former NPC member, I'm very careful about not talking about the exchange rate too much. But one of the things the gentleman who's left was saying that why should the central bank respond to food inflation? And I said that it should happen because there are these second round effects. And inflation targeting hasn't led to persistent negative output gaps, which was one concern when we adopted inflation targeting. You could also, if you look at and this is not a calculation I've done, and so I'm borrowing it loosely, but based on a 40-country real effective exchange rate calculation from September 2016 onwards, when inflation targeting was started, I think the real effective exchange rate is something of the order of 103 or 104. So if you did adopt inflation targeting and you did want to, bring inflation down, you could have overvalued your exchange rate, but it is in that range. So it's also not done that. So I think inflation targeting in India has been successful. It's of course work in progress, but it has been successful as enacted. Yeah, so those are my observations. I refer either of you to. Yeah.
Would you like to respond to?
Sure. I'll make a few points. So on the exchange rate, since I have never been on the MPC, I don't have the problems that Chetan has, so I can speak freely. I think there is definitely a problem. I think the RBI is almost pegging the exchange rate to the dollar in the last 2 years, and that's definitely worrisome. I've looked extensively at the data. So if you look at the volatility of the rupee dollar exchange rate, in the last couple of years, it has come down to 1.9%. It's the lowest volatility that we have had in the last 30 years. It has never been this low since 1990s. So there is a very thin line between the Reserve Bank saying we are managing volatility versus we are pegging the rate. If you manage volatility to this extent, then it is almost akin to pegging the rupee to the dollar, because the rupee is fluctuating within a very narrow range from roughly 83 to 85 to the dollar for the last 2 years, despite a lot of capital flow fluctuations, which is exerting both appreciation and depreciation pressure on the exchange rate. So I think this is definitely something that's worth thinking about. For example, now there is a lot of pressure on the currency to depreciate because foreign investors are taking money out of the Indian financial markets. A depreciating exchange rate could potentially increase the competitiveness of Indian exports, but we are sort of depriving ourselves from that advantage by keeping the rupee remarkably stable to the dollar. So this is definitely a very valid point that you raised, and I'm glad you did that. The second point about freebies, I think it's inevitable, because when we talk so much about the real GDP growth rate of the economy, and we feel good because it's growing at the fastest rate in the world, one thing that we miss is that our per capita GDP is only $2,600. The American per capita GDP is more than $80,000. German per capita GDP is $55,000, right? So we are nowhere close to being a developed economy by any number of years in my lifetime, right? So when you have a per capita GDP of $2,600, you have to give freebies to win elections. There is China is around, I think, $10 to $12,000. Yes, no, $10 to $12,000 per capita GDP. We are at 2,600, so our ranking in the world by per capita GDP is 141. So we are nowhere close to becoming a Viksit Bharat by 2047. So if that's the case, then of course you have to give freebies if you have to remain in power, because the masses in India are not benefiting from the high GDP growth that we are talking about. So that's a big structural problem. And I'll end with this. I think India is in a unique position. What has happened, and the reason why we are talking about these issues, is because it's a unique country which has, as you all know, we have skipped from agriculture to services, and we missed manufacturing. And the reason we missed manufacturing is when we did the 1991 reforms, we sort of did the quote-unquote easy reforms. We opened up the economy, we removed licenses, etc. But as Chetan mentioned during his presentation, we did not do the factor market reforms. So land acquisition, labor reforms, all of which are extremely important for promoting the manufacturing sector, could not be done because in a democracy, the states have power over these issues, and it becomes very difficult. So when you miss the manufacturing bus for almost 30 years, it's too late. So irrespective of whether the global growth is slowing down, China is slowing down, there is a huge opportunity for us to take over some of the slack created by China, but we're not able to do that because the manufacturing sector is languishing. And that is why we have this unique situation where your GDP is growing at a reasonable, whatever, 6-7% because of service sector, but the jobs are not getting created. And I'll leave you with one last number. This is from the CMIE. We have about 1.1 billion people in the working age, which is from 16 to 65 years, because it is one of the youngest countries in emerging world. But the total number of people working out of that 1.1 billion working age is roughly 420 million. And that hasn't changed for the last 10 years. It's like an average 400 to 420 million, right? So no matter what you do, that number is not really moving up significantly. So that's the contradiction we have. We are growing at a certain rate because of services, etc., but we are not able to create the jobs that we need. And this, I don't know what the solution is. I mean, I don't know structural reforms, whether it'll ever happen, but that's the thought that I leave you with. Thank you.
Any solution to that problem that she raised?
I think she started answering it, which is we need to update the series so that we know how fast we are growing. I think Very briefly, I think freebie is an important one. I'm doing some work on states in India, and so we have written few op-eds where we look at the manifestos that different parties have come out with. Pretty much no one talks about reform agenda. Everyone talks about actually freebies. Now, one way to make a dent in freebie culture, which I have written in Ideas for India, how about starting a moratorium on new subsidies? So it is difficult to tackle existing subsidies because that has its own inertia, etc. But maybe we can think of putting an end to announcing new subsidies. That will, to my mind, go a long way. Trump effect, I think as unpredictable as Trump, but I was surprised that the markets shot up significantly the next day, and there were some analysts talking about how it can probably lead to fragmentation in the global economy, but we might benefit, and as a result, markets were up. But I don't have a particular viewpoint on this. On last point, on large firms entering realty, to my mind, it's a good thing because I think the sector is one of the most monopolistic, opaque sectors. There are some large firms who make disproportionate amount of profits. So if organized players are entering into it, then I think it's a good thing. It will make the sector competitive and hence make it little more affordable because that is the inherent nature of competition in any sector.
I was just saying that you need to, when you're talking about exports, this is not manufacturing oriented or even production potential oriented investment. It is a balance sheet oriented investment. So the avenues available for profitable investment in the eyes of the corporate are far lower than their investment behavior indicates, because a large portion of their investments is going to the reality sector and not into manufacturing or export oriented.
But it creates enormous jobs, Ranga. It creates enormous jobs.
It does. I'm not observation that you need to factor this in when you're talking of the Indian economy and the growth potential and export potential of the economy. Just an observation.
Yeah. Conclude. Yeah. Okay. Thank you very much. There is no way I can probably sum up this rich discussion. So I won't intend to be that adventurous. What I would do is that say that a big thank you, a vote of thanks to Dr. Chetan Ghate, to Dr. Rajeswari, to Mr. Shishir Gupta, and to all the participants here who made this discussion very rich and a lot of takeaways which we could mull over. And I'm sure at some point the government, the RBI, will look into this, the issues that have been raised here. Once again, thank you very much. And do we go for the lunch?
Just two small announcements. One is that looking at the demand and with a view to reach out to larger audience, we have also live streamed this program on our YouTube channel. And second is request to all of you that we have arranged lunch for everybody next door in Terrace Pergola. Please join us over there. Thank you very much. Thanks to the chair. That's right. Yes. Thank you.